Morning, Mr. Green. Mr. Jones.
Good morning. Good morning.
Mr. Grable. If anybody else could just turn on your cameras, that way we know we have our quorum and we can get started. Morning, Mr. Sound. Morning, Mr. Popowich. Mr. Bernstein.
Morning.
Mr. Kelly. I think we have the majority of our folks. Okay, we'll call this meeting to order. Linda, would you please read any announcements and then call roll to confirm attendance?
Absolutely. Thank you, Chair Knox. The meeting is being conducted as a virtual meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Green?
Here. Good morning.
Good morning. Mr. Santos?
President, accounted for.
Thank you. Mr. Kehoe?
Present.
Thank you. Ms. Greenwood? Mr. Jones?
Present.
Thank you. Mr. Bernstein?
Present.
Thank you. Mr. Kelly?
Present.
Thank you. Ms. Sanchez?
Here.
Thank you. And Chair Knox?
I am here as well.
Thank you.
Thank you.
Staff,
Go ahead.
sorry, just one more.
Yep.
Staff participating in the meeting include the following: Chief Investment Officer John Grable, CEO Santos Crayman, Interim Chief Counsel Johanna Fontenot, AEL JJ Popowich. Principal Investment Officers are Jude Perez, Vacha Masarajian, Jim Rice, Ted Wright, and Chris Wagner. Senior Investment Officer Scott Drazel and Scott Drazel. Investment Officer Dale Johnson, Didi Acevedo, and Robert Santos. Senior Investment Analyst Mel Chow, Jeff Gia, Calvin Chang, and Adam Chang. Interim Chief Financial Officer Ted Granger and Systems Division Manager Kathy Delano. Consultants participating in the meeting include Ashley Dunning and Peter Mixon from Nossaman Group, James Walsh, Stephen Kennedy, Mark White from Allborn, Jose Fernandez and Natalie Walker from Stepstone, Leo Festino, Stephen McCourt, Alina Wan, Tim Filla, and Jonathan Camp from Makita Investment Group. Trustees, if you have a comment or question on any item, please use the Zoom chat option to be placed in the queue, or you may contact me directly. At this time, we ask all meeting participants to mute their mics until you're ready to speak, and we may proceed with the agenda.
Thank you, Linda, and certainly want to welcome Patrick Jones again to the Board of Investments. I know several folks said good morning in the committee meeting this morning, but we certainly welcome you to the larger group and to the board.
Thank you. Good morning to you, everyone.
The second item, approval of the minutes. We did get a couple of items in advance. There was one minor typo in the report of closed session where the full year of 2020 was not typed out. And then there was a request when trustees step away or are not included in a vote that be recorded as absent rather than just stating that the vote was unanimous. So Linda, you'll make those changes going forward from this point, correct?
Correct. Yes.
Perfect. Other than that, were there any other comments on the minutes?
No, just move approval with the amendments.
Thank you, Mr.
Second.
Santos.
Second.
Second by Mr. Green. Linda, would you
Okay.
please call roll?
Yes. Mr. Green?
Aye.
Mr. Santos?
Aye.
Mr. Kehoe?
Aye.
Ms. Greenwood? Mr. Jones?
Aye.
Thank you. Mr. Bernstein?
Aye.
Mr. Kelly?
Yes.
Ms. Sanchez?
Aye.
Chair Knox?
Aye.
Okay, motion passes unanimously.
Okay, item number 3, report on closed session items. The report on closed session items from the last meeting was published and is available on LACERA.com. Ms. Fontenot, was there anything to add to that? Hearing none.
No, sorry about that.
That's okay. I caught you off guard.
Yeah, you sure did.
Surprise. Thank you for joining us today. Appreciate it.
Yes, of course.
Item number 4, public comment. Linda shared one written public comment via email with the trustees this morning. So I would encourage you to review that. And then I believe we also have one person signed up for public comment this morning, Linda.
Yes, we have a request from Damian Goodman. We will bring him in the meeting now.
Thank you very much.
Mr. Goodman, you can go ahead and enter *6 to unmute
Hearing
yourself.
none. Yeah, sorry about that. That's okay. I caught you up.
Mr. Goodman, good morning.
Hello? Can you hear me?
Yes, Mr. Goodwin, we can hear you. Go ahead, please.
Good morning, Board of Investments, and welcome to the board, Mr. Jones. This is Damian Goodman. I am the board member of Downtown Crenshaw Rising, of the community-based group and nonprofit Community Development Corporation, which is sought to acquire the Crenshaw Mall. Bids were due with a timeline set by Deutsche Bank's DWS on February 19th. As of this Monday, well over 7 weeks later, there is no signed TSA. What it has shown, board members, is that the rushed timeline in an attempt to discriminate and make it more difficult our bid for the Crenshaw Mall was completely arbitrary, completely capricious. This board needs to begin considering at what point its fiduciary duties and its specific role in its capacity as the advisory committee that directed the general partner to retain DWS, which has multiple assets of LACERA under its control, is being challenged with these actions. We have presented a fully financed offer backed by the best and some of the largest names in philanthropy, social impact investment. We have presented to you a community with over 300 organizations, and you've received personally over 17,000 emails among the 27,000 displays of support through petitions and emails for this effort. There is a tremendous opportunity to show the world how development can be beneficial and not harmful to communities like Crenshaw that is being missed by Deutsche Bank's DWS, but that is also being allowed by LACERA. And so we look forward to continuing to advocate and work with you toward having a solution that addresses the fiduciary needs, responsibilities of this board and the community in which we live in. We're not going away. We live here. Thank you.
Thank you very much, Mr. Goodman. Linda, do we have anybody else in the queue?
No, we don't.
Okay, that concludes public comment for this morning. Moving on to item 5, the Chief Executive Officer's report. Mr. Kryman.
Yes, good morning, Chair Knox and trustees, and welcome, Mr. Jones, to the LACERA family. Looking forward to working with you in the future. So I have some very brief comments. I know that we have a very full agenda, but I did want to update you on our efforts through March Madness. Our workload figures have definitely increased year over year in all categories, phone calls, applications processed. We're in the final stages of putting the final members that applied for March retirement on payroll. I think we have about a dozen or so more applications to get to and to verify. The big effort now will be to try to transition our new retirees into their healthcare plans, and that, of course, is a pretty Herculean effort, but we're up to the task, and our retiree healthcare folks are busily processing those applications. Wanted to let you know that the recruitment for the Deputy CEO position is ongoing. We've whittled it down to 2 finalists that Mr. Grable and I will be interviewing. I believe it's the end of the month. I'd like to meet them in person, and so we will be bringing them into LACERA so that I can meet with them and have a really good discussion about the position and their qualifications. Last item is that you may have noticed that on LACERA.com, we do have an RFP that we let for labor consultant services. As you may know, that the memorandum of understanding is scheduled to expire by the end of the calendar year. So I'd like to get a head start in trying to figure out a strategy for negotiation with our union partners. And so that is out on the street. So with that, those are the items that I wanted to bring to your attention. I'm more than happy to stand for questions on anything I discussed or anything that's included in the CEO report.
Sure, thank you. I have Mr. Santos in the queue.
Morning, Mr. Kryman.
Morning.
Thank you for your brief comments. Last week, the Board of Retirement Operations and Oversight Committee received an outstanding presentation regarding our cyber security readiness, I'm going to call it. I thought it was very insightful. I suggest that the Board of Investments get a similar presentation. I think it's really important that the presentation be geared for how we are protecting our investment portfolio. So I would really appreciate if you can do that in the near future.
We will work with Chair Knox to try to get that onto the agenda.
Thank you, sir.
Thank you, Mr. Kelly.
Good morning. I had two questions. The first you addressed, which was the status of the chief deputy recruitment. Your monthly report had shown the same status report for the last 3 months, and so it's good to know that we're making progress there. The second is related to an ongoing concern of mine about the number of retirees who have emails on file with LACERA. Last month, I brought up this issue, and I suggested to you that you report back, but I haven't seen any report back, and I just wanted to remind you that's a pretty material issue for me. It reared its head recently when Mr. Grable sent out an email regarding an issue, and inquired if, in fact, that email was going to by mail to those who did not have an email address on file with LACERA. I think for retirees, it's 50% of the population does not have an email on file with LACERA. And your response was no, that was going only by email. So in my mind, that was a pretty material communication from the chief investment officer that didn't go to half the population. So I'm still very interested in that. And if I could have a report back, or we got a report back on that, or if you want to present it to OOC, I'll attend the OOC meeting, whichever way you want to go. But I still am uncomfortable with the status of that issue. And I would appreciate some response. Thank you.
Okay, we will, I believe, if I remember correctly, we did make a presentation to the OOC, but we'll bring it forward to the Board of Investments as well to discuss it.
Or refer me to the OOC. I couldn't find it in OOC, so if you refer me to it, I'll look at it there. I don't want to take up too much time with this.
Mr.
Board, but
Mr. Popovich will send you the information.
Perfect. Thank you very much.
Thank you very much. Seeing no other speakers. Moving on to item 6, the Chief Investment Officer's report. Mr. Grable.
Good morning, Mr. Chair. Good morning, trustees. Welcome, Mr. Jones. We look forward to working with you. And thank you, Cindy Rivera, for driving the slides today. I am going to timestamp my comments in a sense that I'm mad at John Dorfman from Napier Park, in that there's some overlap in terms of my prepared remarks and what he said. We share a first name, but not notes or brain. But I will keep with them just because I think they are important. So Cindy, if we can turn to slide 4. Thank you. And this slide is not a mistake. These are some of the most remarkable numbers that I've seen in my career. If we look on the charts on the top row and the bottom left, the last 12-month returns for equity markets through the end of March are north of 50%. Now, it's true that this is from a depressed level, but notwithstanding that, 50% plus returns are remarkable. And it reminds me of a research paper that Makita wrote, I believe it was back in 2018, about endpoint bias, and that in it, it says that end dates and start dates matter when measuring performance. It's a good read. This data is noisy, but I think it's really important to recognize that not that data is manipulated, but data can be noisy. What else this chart shows in the bottom right is the year-to-date performance of the Barclays Ag, or the broad investment grade bond market. It's down 3.4%. And as we all know, rates and returns move in opposite directions, but rising rates, albeit modest, can impact all capital markets and investment strategies. If we can turn to slide 7, please, Cindy. There is a lot on this page. It talks about COVID, once again, interest rates, global equity performance, inflation, liquidity. One thing that I'll pull on the string a little bit is global GDP growth, and that stands out. Global GDP growth in 2021 is projected to be north of 6%, according to the IMF. And if we think about global GDP of being about $85 trillion, 6% of that is north of $5 trillion. And that's about Japan, which is the world's third largest economy. So that type of growth in the global GDP, once again, is a rather resounding strong number. And based on that, we're starting to hear the phrase, the roaring 20s, to describe the good times ahead. And that phrase bothers me a little bit. Obviously 6% growth is better than the alternative, but we need to look beyond the label of everything is good in front of us. Not that I was around, but the roaring 1920s were not good for everyone, nor will the roaring 2020s. And that was part of what Napier Park showed in the different quartiles of income returns. And that many of the broad strokes, such as things where you put a label that the roaring 20s, that really focuses on the outcome for the median. And for LACERA, we focus mostly on median performance when we think about things such as our strategic asset allocation. We assume a bell curve with the supermajority of outcomes bunched near that midpoint. So the roaring 2020s may materialize for the median person in the developed world. However, it's important for us to focus on broader statistics as we construct our strategic asset allocation and implement our asset categories. Normal or non-normal distributions, skewness, may exist and can inform us. For our strategic asset allocation, there may be climate externalities that may be in the out years. For implementation, trends may impact how we allocate between active and passive mandates. We're starting to add risk reports to the CIO report to better monitor and facilitate these discussions. And I certainly hope that the roaring 2020s materialize for LACERA and all our members. Cindy, if we could turn to slide 9, please. This is through February. The net asset value for LACERA was $66.4 billion. The pension was up 1.4% net. It's not on this page, but we're close to $69 billion today. That's a great number, a high watermark. As we'll see on the next slide, that we are within bands on all asset categories. We're most overweight growth. We're most underweight risk reduction.
Mr. Grable?
Yes.
Just quickly on the previous slide, I always like that cash chart that you have. That was a pretty big drop in cash. Was there one significant reason behind that, or?
It is, and sorry, I'm trying to pull up my screen because I lost the Zoom. Here we go. The cash, it is up as of the end of March. Our target is 1%, so we really tend to stay at target 1%. We anticipate cash needs, and we did a rebalancing in March to get to a little bit north of the $547 million shown here. But we have adequate liquidity. It's something we monitor on a daily basis, and much of the portfolio is in public stocks, in investment grade fixed income that has settlement within a couple of days.
Thank you.
So if we stay on slide 10, the OPEB trust, also as of the end of February, was at a high water mark of 1.9 billion, up about 1.9% for the month. This is a remarkable number. Fiscal year to date, it's up over 19%. So if we can turn to the next slide, please. And these were a couple of the charts we introduced last month. The chart on the upper left measures asset category contributions to risk, and we define risk as volatility. Ms. Sanchez mentioned earlier about nonlinear risk, and we do recognize that there are shortcomings to this, but it's a step to a more thorough and comprehensive way about thinking about the portfolio beyond just returns. Growth is 51.6% of the assets that we can see on the right, and it is 76.6% of this measure. And once again, so it's a majority of our risk, and we're also on the low side compared to peers with our growth allocation. Many have much higher growth allocations than LACERA does. And in many ways, this is the big decision we'll discuss later this morning during the asset liability analysis provided by Makita. We need to think about how much risk, how much diversification, and at the same time, staying true to our investment beliefs. And I think it's really critical that we have investment beliefs because it really helps guide these discussions. And a couple of the things that stand out to me in our investment beliefs for us to think about is, we have a global perspective. There's a statement that no risk is risky, that we believe that it's important to have diversification across risk factors, and that we need to include ESG considerations as a measure of risk. The other thing we need to think about, given that we're on the low side compared to peers with our growth allocation, is to avoid chasing momentum after the fact. Next slide, please. And on this slide, I'll reiterate the points from last month because they really are important. Active risk measures how we differ from our policy portfolio, otherwise known as our strategic asset allocation. And there are two components of that: allocation over and underweights and manager security decisions. And by manager security decisions, that includes things such as an investment grade bond manager that may choose to invest in credit, for example. Our total active risk at the end of the month was 149 basis points. That's similar to the prior month. I'll point out that the cash overlay has a negative contribution, and that is by design. The overlay is used to rebalance the fund towards its policy targets. The chart on the right shows our active weights compared where we stand to targets. Growth is 51% actual compared to 47% target. Active risk from growth is 46 basis points. 31 of those come from allocation overweights, and 16 or so come from manager decisions, such as factor tilts towards value or market cap weights. As I mentioned last month, the majority of fund active risk is from core and value-added real estate. That's 74 basis points of a total of 147.9 from a small 6 to 7% allocation. And it's really important for us as we this summer have a structure review to think about how we allocate our active risk. And once again, that will come from a structure review. Slide 19. And this is one of two charts of the month from the team. And this really is the point that Mr. Dorfman made, that this past quarter was the worst quarter for treasuries, US treasuries, since 1980. And the impact, and what I really thought about, is that we have two generations of money managers who have little experience managing assets in a rising rate environment. And this doesn't just impact credit or fixed income managers. This crosses all asset categories. So for me, the caution flag is waving. This is something that we really need to be mindful of. And with that, Mr. Chair, I'm happy to stand for questions.
Okay, I believe we have Mr. Kelly in the queue.
No question, John, you answered it.
Okay, thank you. Any other questions from trustees?
Yes, I have a question, a
Go ahead,
comment.
Mr. Santos.
Thank you very much. Yeah, with regards to Mr. Grable, with regards to the interest rate, I remember when I first bought my first home in the 1980s, I believe I was paying 16%, and that was the VA loan. So you can imagine what the rate was. But that's a long time ago, and probably a lot of those money managers probably retired by now. I wanted to compliment you on your continuous reference to the investment beliefs. It's really important, and I just like to mention to my colleagues that it took years and a lot of discussion on the Board of Investments to adopt investment beliefs. And it's really great to see how our investment staff and consultant Makita makes reference to the investment beliefs. So we have come a long way along with ESG. And the last thing I'd like to mention is that we have public comment that was submitted, written public comment that was submitted with regards to the email or information you sent out, Mr. Grable. I will definitely hope, and I'm sure you probably will be responding to that, and I will definitely would like to get a copy of that, because I think it's really important that we be more specific in terms of our strategy when it comes to diversity and the value that we allocate for diversity, and that doesn't mean that we're going to compromise a goal of an fiduciary duty to our members. After all, it's our money, and we're not going to, as long as I'm on this board, I would never compromise my duty to maximize returns and minimize the employer liability. So those are my comments. Thank you very much.
Thank you, Mr. Santos. Seeing no one else in the queue, thank you, Mr. Grable. Moving on to the consent portion of the agenda, item 7A. Do I have a motion?
Move the item.
Thank you, Mr. Kelly. Seconded by Ms. Sanchez. Any discussion? Linda, can you please call the roll?
Sure. Mr. Green?
Aye.
Mr. Santos?
Yes.
Mr. Kehoe?
Aye.
I don't see Ms. Greenwood. Mr. Jones?
Aye.
Mr. Bernstein?
Aye.
Mr. Kelly?
Yes.
Ms. Sanchez?
Aye.
Chair Knox?
Aye.
The motion passes unanimously.
Thank you. Moving on, non-consent, item 8A, recommendation submitted by Mr. Drazel. Deliberate whether or not to nominate a candidate to the International Corporate Governance Network's Board of Governors. Mr. Drazel?
Sure. Good morning, Chair Knox and trustees. The ICGN, or the International Corporate Governance Network, has announced an open call for candidates to serve on its Board of Governors. LACERA has been a longstanding member of the ICGN. So item 8A is, as you presented, it's an opportunity for trustees to deliberate whether to put forward a LACERA candidate, consistent with LACERA's policies that nomination opportunities like this be brought for the board's consideration when time permits. For quick background, the ICGN has a nominating committee that reviews submitted candidates and puts forward a slate of candidates for a vote by the full ICGN membership. That vote is scheduled to take place later this fall at the ICGN's annual meeting. We provided links for trustees' consideration to the terms of reference document that details the responsibilities and expected time commitments that folks might want to be aware of. And the deadline for any submission of a LACERA candidate would be May 4th, UK time. So perhaps a day early might be prudent. Welcome any questions or discussion.
I have a Chair Knox.
Gina Sanchez.
Sure.
Just one sec so I can hear what let me hear what the motion was again. Mr. Bernstein, I heard you a split second before Mr. Santos, I think.
First of all, Mr. Drazel, congratulations on your election at CII as their new chair. That's wonderful, and we're honored to have you doing that. Last year, I believe it was last year, we nominated Mrs. Sanchez. I thought that was a good idea. Sometimes these things take a few years, and I would move that we try again and that we nominate Mrs. Sanchez for the position.
Second.
Okay, we have a motion and a second. Any other discussion? Thank you. Linda, can you call the roll, please?
Yes. Mr. Green?
Yes.
Mr.
Aye.
Santos?
Yes.
Mr. Kehoe?
Aye.
Mr. Jones?
Aye.
Mr. Bernstein,
Aye.
Mr. Kelly,
Yes.
Ms. Sanchez,
Yes.
Chair Knox.
Yes,
Okay, motion passes unanimously.
thank you. Moving on to item
And thank
8B.
you.
Another recommendation by Mr. Drazel regarding proxy research and voting platform services, and then additional limited coverage proxy research services.
Sure, and I'll kick off with some introductory remarks on this one and then pass it off to other members of the evaluation team. 8B is LACERA's RFP results for proxy voting platform and related research, as the chair outlined. The board approved the RFP last fall, which the team has conducted in adherence to the procurement policies that the board has to conduct an RFP on a periodic basis. As the board is aware, LACERA votes now over 7,000 portfolio holdings in more than 65 markets, according to the custom policy that's outlined in LACERA's corporate governance and stewardship principles that the board approves. To do so, we use an online voting platform that integrates research covering all the various items that could appear on corporate proxies of shareholder meetings around the world. The universe of firms that provide that type of integrated voting platform and research coverage is limited to 2 companies. We currently use both. ISS is the provider of the online platform that receives electronically the proxies that were eligible to vote, integrates research for every company consistent with our custom policy, and then helps record all those votes so that we can analyze and report back to you as the trustees on voting trends as well as publicly. We use Glass Lewis on a more limited basis to access research at shareholder meetings that might be unique, like a merger or proxy contest, in order to get some additional perspective on different items that might arise. So although the universe is limited to 2 firms, conducting the RFP both aligned with LACERA's procurement policies and was timed after we had significantly expanded the proxy voting authority to ensure that we continue to receive competitive economic terms on these services. Also, despite the limited universe of really just 2 key players, we try to cast a wider net in the RFP to entertain responses from any firms that might provide ancillary research that could help inform our voting. So the evaluation team consisted of Mel Tsao and Dale Johnson. We're recommending continuing the status quo of using ISS for the voting platform and Glass Lewis for limited additional research. Both firms have served us well, and we're pleased to indicate for trustees' interest that although we've had competitive economic terms through the process of the RFP, if approved, we've been offered more for less on a per unit basis. So Mel and Dale are prepared to go over the search process and results. And with that, I'd be happy to turn it over to Mel to provide further context.
Thanks, Scott. If we can move to slide 4. Thanks, Cindy. Slide 4 is a brief overview of LACERA's proxy voting program and process. As trustees are aware, LACERA's investment policies consider proxy votes to be plan assets and call on LACERA to manage proxy voting in a manner consistent with creating long-term value of the trust. LACERA votes proxies according to its own custom corporate governance and stewardship principles as the board approves. After significant expansion of LACERA's voting authority, LACERA now votes over 7,000 meetings annually spanning across 65 capital markets globally, representing approximately 90% of the global equity portfolio. Slide 5 reviews our current vendors and rationale for the RFP. As Scott mentioned earlier, LACERA utilizes both ISS or institutional shareholder services and Glass Lewis for proxy related services. ISS provides the proxy voting platform and research which the team uses to integrate LACERA's custom voting policy and to cast and record votes. Glass Lewis provides limited research for added perspective on contentious voting items such as proxy contests. Given LACERA's recent significant expansion of proxy voting, as well as consistent with LACERA's procurement policy, which requires periodic RFPs, it has been a good moment to review market offerings and competitive pricing so that LACERA receives the best qualified proxy research services to meet LACERA's needs. Slide 7 presents the 4 key desired competencies the team uses to assess RFP respondents and identify the firm with the most suitable proxy voting platform and 1 or more firms to provide proxy-related research to help inform and apply LACERA's principles in voting. These criteria were the voting platform, proxy research, the firm's ability to adequately integrate LACERA's custom voting principles, and lastly, the firm's ability to provide robust tools to conduct reporting and analysis of the proxy votes. In the next slide, slide 8, members of the evaluation team has benefited from representation from both the corporate governance and the global equities group. And we present here some of the specific considerations the team had in assessing the RFP respondents. Slide 9 depicts the 4 phases of the evaluation process and timeline, beginning with the approval of the minimum qualifications and RFP last fall. The evaluation phase included trial access to different services and offerings, diligence interviews, and reference calls. Slide 11 summarizes the team's evaluation of the 3 responses received. Consistent with the desired competencies mentioned earlier on slide 7 and the considerations and influences criteria on slide 8, 1 respondent, Equilar, did not advance. While they provide valuable research on focused governance topics, the team felt the services were beyond LACERA's needs at this juncture. 2 respondents, Glass Lewis and ISS, did advance for interviews and further evaluation. Slide 12 highlights some key organizational details of the 2 finalists. The table illustrates both firms have solid capacities to be considered. I will now turn it over to my colleague, Dale Johnson, who will cover the team's analysis and recommendation.
Thank you, Mel. Good morning, Mr. Chairman and trustees. Starting on slide 13, I would just like to reiterate that while Equilar did meet the minimum qualifications, upon evaluation of the written response, we identified that they do not provide a proxy voting platform and that their research primarily covers, as Mel said, executive compensation and equity pay. While this research could be complementary, it is considered ancillary, and this research was focused on global proxy research. So the table at the bottom slide of the slide shows the categories contained in the RFP and the scoring by the evaluation team members, resulting in ISS ranking higher than Glass Lewis overall. Generally, ISS scored slightly higher in a majority of the RFP evaluation sections and is reflected in as is reflected in the previous slide, as both vendors are well-established, well-resourced, and while ISS has been providing these services for over 30 years and generally has more economic and human capital resources. Slide 14 summarizes the costs of the various components of the services provided by the finalists. The first line of the top table is the annual fee quote for the proxy voting platform and full research coverage of LACERA's global public equity portfolio. This is an apples to apples comparison. The second line in the top table includes costs for various additional optional research resources. These costs vary depending on the depending on the product and or number of products subscribed to. Both vendors offer a vote disclosure service, which is where the vendor would post LACERA's proxy votes. ISS also offers market voting statistics, which tabulates statistics for all meetings across the globe, not just LACERA's holdings. Director data may assist LACERA with evaluating board diversity for large cap US companies. The bottom table is the annual fee quote for, thank you, Cindy. The bottom table is the annual fee quote for limited coverage proxy research. Additional limited coverage proxy research, as noted earlier, would provide LACERA with additional analysis and perspective on contentious meetings and or unique ballot items. Slide 15 addresses some of the concerns and potential mitigants of both finalists. Focusing on the ownership section for ISS, as noted, Genstar will continue to own 20% of ISS, but as a silent partner and will not have any active role in the management of ISS. Focusing on the research conflicts section, the 4th row down, for ISS, the corporate advisory business has been a long-standing business line at ISS and provides financial resources for the broader organization. The business lines and issues around potential conflicts of interest were evaluated and considered in the scoring of the organization section of the RFP. Moving on to the reporting section, the last row on the table, I'd like to note a typo. Thank you to Mr. Kelly for catching. Propriety should read proprietary. LACERA presents voting information according to 5 core areas outlined in our corporate governance and stewardship principles, and some data management is required to categorize the vendor's data to LACERA's reporting structure. It should be noted that there are no significant concerns with either firm that would preclude LACERA from recommending either one. Slide 16 displays the firm diversity and inclusion profile for each of the finalist firms. We followed up with both firms during the due diligence period, and while they currently do not systematically capture and track LGBTQ+, as it is not reported in their EEO1, they both affirmed in the DEI DDQ that they would be willing to report DEI information going forward if awarded the contract, and we will be sure to include this request into the contract. Moving on to slide 18, upon completion of the RFP process, including comprehensive reference checks, the evaluation team recommends the selection of ISS for proxy voting platform and full coverage proxy research services, and Glass Lewis for limited coverage proxy research. The table lists the prospective costs for each of the services and the potential aggregate annual costs, including this prospective cost should LACERA choose to elect any or all of the additional optional research resources. The recommendation continues LACERA's current profile with ISS providing the proxy voting platform and full coverage research, and Glass Lewis for limited coverage proxy research. The proposed annual fees are generally in line with LACERA's current overall cost profile for voting platform and research, but also includes, as Scott noted it earlier, additional capacity for growth in portfolio holdings. That concludes our presentation. We're happy to take any further questions.
Thank you very much, Mr. Johnson. Mr. Drazel, I have Mr. Kelly in the queue.
Good morning. I had submitted a number of questions to staff, which they addressed in their comments, and I wanted to thank them very much for that. It was well done.
Thank you.
Appreciate it. I had one question related to the optional research resources. Do you have a few quick examples of things we've done in the past?
Sure, Mr. Knox. One of the services that ISS provides tracks the vote outcomes of different proposals and allows us to kind of search and sort across the market to understand context. So we have made use of that service and think that it might be an additional add-on. Another item is ISS is looking deeper into board composition, including trying to capture different diversity attributes to the extent that they're disclosed. And going forward, that might be a useful tool to provide an additional lens in evaluating which boards cast a wider net for talent and which ones don't. That continues to be emerging as we've discussed at earlier board meetings. So what we would propose here is structuring the contract that those would be optional services that we can opt into. But if they're not providing valuable insights, we can also discontinue in our economic interests.
Thank you. I have Mr. Santos next, please.
Great, thank you. Thank you, Mr. Dreisel, for your presentation, and you, Mr. Johnson. We have a policy that calls for reevaluating our relationships every 5 years, RFPs. But like every policy or rule, there are exceptions. And here, I'm wondering if you can tell me the benefit that we derive from this RFP vis-a-vis the costs, right? Because I believe, and tell me if I'm wrong, that we could have negotiated with this particular manager or consultant for some of the goodies that we got this time and avoided the RFP. I'm not advocating to eliminate RFPs in this situation, but from time to time we need to look at, we all knew that there was only Glass Lewis and ISS. The other ones, the other firms that applied, they could not, as you guys found, they could not really compete with ISS in Glass Lewis. So it might be a situation that from time to time we may have to invoke the exception and bypass the RFP. But tell me, what was the benefit in doing this RFP at this time that we could not have them through just regular negotiations?
Sure. Thanks for the question and the perspective, Mr. Santos. Like, one straight benefit is the procurement policy as written does require the periodic RFP. So as a governance provision, we're able to say that we're complying with that policy. And perhaps we can revisit that when the procurement policy comes up. But on the economic terms, as we've expanded proxy voting in recent years from 19% of the portfolio value to now over 90%, we've tried to keep pace by ensuring that the enhanced volume is priced in a way that captures what we believed to be competitive economic pricing. And from our reference checks and discussions with peers, I'm comfortable to represent that was the case. We had good terms. We did, through the RFP process, improve that even more, relatively marginally, but it was an enhanced result through the RFP process on the competitive process.
I think Mr. Grable has a comment, and I will, through the chair, appreciate to hear Mr. Grable's comment on this topic.
Sure.
Thank you, Chair Knox and Mr. Santos. A couple of thoughts are, one, whether we do a public RFP or not, the team does a thorough analysis such that it may not be quite as much as a public facing RFP with this level of detail in a slide deck, but the work would be just as thorough if we didn't do an RFP. The second is, I understand the point, and to the extent there is a highly limited universe, it's something that we can bring to the relevant committee going forward if an RFP may not benefit the fund, if there could just be a negotiation and potential report out to the board of the benefits. So we understand the point.
Thank you.
Thank you very much, Mr. Grable. Any other questions or comments? In the absence of those, I'd be happy to entertain a motion.
I'll move the item.
Mr. Kelly moves.
Second.
Seconded by Mr. Santos. Any other discussion? Linda, can you please call the roll?
Absolutely. Mr. Green?
Aye.
Mr. Santos?
Yes.
Mr. Kehoe?
Aye.
Mr. Jones?
Aye.
Mr. Bernstein? Mr. Bernstein? Mr. Kelly?
Yes.
Ms. Sanchez? Yes. Okay. Chair Knox?
Yes.
Okay, I'm going to go back to Mr. Bernstein one more time. Okay. Motion passes unanimously.
Thank you. Moving
He
on.
just texted me.
Oops.
He's an aye. Sorry.
Okay, thank you.
Okay.
Thank you. Moving on to item 9, reports. 9A, strategic asset allocation and asset liability study review. Mr. Perez.
Cindy, if you don't mind pulling up Makita's presentation on the strategic asset allocation liability study review. Thank you, Cindy. Good morning, Chair Knox and trustees. As you mentioned, the next item on the agenda is one of 3 items today discussing the strategic asset allocation. In this first presentation, Makita will expand on the asset liability study that was discussed at the last meeting. So the objective for today is to identify the board's risk tolerance as it comes to the strategic asset allocation. This presentation, I want to mention, is not meant to provide an overall recommendation, but to guide the allocation options that Makita will bring forward to discuss at the May Board of Investment meeting. So with that short introduction, I'd like to hand it over to Stephen McCourt, Leandro Festino, and Jonathan Camp from the Makita Investment Group.
Thank you, Jude, and good morning, trustees, staff, and members of the public.
We're pleased to share this presentation with you today. As you will recall, this is one in a sequence of presentations we have been going over asset allocation and liability studies since sometime late last year. We went over many things in that time, including a survey where we capture your feedback and perspectives, and that will be put to use today in the presentation. Probably the best way to summarize today's presentation is with an analogy. If you're looking to buy a house, first you look at the neighborhood or the city or the general area vicinity where you want to live. But that's what we're trying to do today, find the general vicinity for your risk and return preference and tolerance. And at the next meeting, we'll come and find the house within that vicinity or neighborhood. In other words, the right asset allocation for the fund. So we'll start today on the next slide with a quick overview of the agenda for this first presentation. We'll go over mean variance optimization results of some portfolio options for you, which essentially means optimizing on two variables, risk and return, and that's a good starting point. And then we'll do some shocks to that. We'll incorporate liability. We'll incorporate your feedback from the survey. And again, with that, the main goal, as we'll have on the next slide for today, is to just have some direction as to which risk return sector, if you will, of the efficient frontier makes the most sense for you. We have one slide also that details, the next slide, please, that details a bit of history. And I'll say going back even 10 years, there's been some changes, but not that dramatic. One that is observable is a decrease in the weight public equities in favor of other asset categories. You know, it was about 52% in 2010, and it has come down. And then the other major change has been the look at asset classes instead of from a name or category, from the function or role that they play in the portfolio. So you'll see that starting in the latest study in the last few years. And keep in mind, there's always a certain degree of judgment here. So for example, real estate to some degree could be considered growth, or it could be considered real assets. And so these numbers provide some perspective. That's what I'm saying. It's not that dramatic, but there's been some changes. The most notable, again, the decrease in the allocation to public equities. With that, I will invite my colleague Jonathan Camp to take us over the slide 6, which is a good summary slide as well for this presentation.
Yeah, thanks, Leo. So I'm going to spend a minute talking about this, the information that's on this slide. And part of that is because the framework that you see here is really a launching pad for the remainder of the asset liability study. So what you're going to see in the top right is the mean variance optimization. On one axis, you've got your expected return. On the other axis, you've got your volatility. And so we start by graphing your current policy allocation and your actual allocation as of the end of 2020. And then what we do is we build around that these gray dots. These are alternative portfolio options that we are testing to see if they provide some enhanced return or if they minimize risk, or both. And then what you see on the orange dots are what we call an efficient frontier. So these are the allocations that really rose to the top of being most optimal. And then next to that, you see policies A through E. So these are just sample policies. These are not meant to be recommendations, as was mentioned before. And the structure of how we set them up was to really span the spectrum of risk and return. So that's why you see A very low on the return spectrum, and then E is on the very higher risk spectrum. And then what I wanted to point out is when I'm looking at those samples, you may notice that not all of them are on the efficient frontier. And so this is on purpose. And this is where it becomes a bit of art versus science. So the policies that we've selected for comparison, the gray policies, some of them are not necessarily the most realistic from the stance of your current positioning in your portfolio or even your liquidity expectations. So they're mainly a reference point. And the samples that we've chosen, we think are more realistic. And when I think of LACERA's investment belief number 5, I think we think of risk as being both qualitative and quantitative. So I wanted to point out that the remainder of what we're presenting is going to be very quantitative in nature, but there's also this art that we need to balance it with. So if we wanted to flip to slide 7, a few additional stats here. This is the same chart that you saw in the prior slide, but there's a few additional rows added. And what I want to point out real quickly is that the Sharpe ratio in yellow there, the Sharpe ratio is our measure of compensated risk. The measure is very similar across the A to E spectrum. And so what that tells me is that even though we're taking additional risk with portfolio E, we believe it's compensated risk. And so that's really represented in the Sharpe ratio. And then right below that, you'll see an assessment of how liquid these portfolios are. All of the samples that we're showing you have an increased illiquid asset allocation. And then the bottom line is the probability of achieving over 7% over 20 years. And 7% is the discount rate that's being used currently on the liabilities. And so we're not necessarily using this as being too strong of a reference point, but it is worth mentioning how achievable that 7% is with these different samples. So if we wanted to flip to the next slide. So this is really the starting point of the asset liability study. And as was mentioned before, we provided a survey at the end of 2020 to get the board's sense of what metrics were really the most important. And what we learned from that study was that the funded status of the plan in the future was the number 1 and number 2 factors that we should consider. And so what you'll see throughout the remainder of the presentation is a strong focus on the funded status and funded status risks. Slide 10. So I'm not going to spend too much time on slide 10 and 11, but this is really a setup for the remainder. What we're doing is we are simulating your current policy and your current plan through a number of economic scenarios, and all those scenarios are represented in that top left. And what we're showing is the future funded status of the plan. And then what we do is we take all those results and we create this corridor, and we create these percentiles for expectations. And so you can see in 20 years, we think that your current policy is expected to generate an 87% funded status at the end of 20 years. And that's really what we're taking from this. So on slide 11, we're then taking that corridor and we're pulling out additional statistics to create these scatter plots that you'll see on the next few charts. But right here, just wanted to highlight some funded status metrics. So that, again, that 87% at the end of 20 years. And then we're also going to look at a short-term downside funded status. And for this, for the current policy, at the end of fiscal year 2022, we think that your funded status would be 61% in a very extreme downside scenario. So slide 12. So this is really the first scatter plot that we're showing you in relation to the survey results. This scatter plot is now, instead of focused on mean variance optimization, we're focused on the funded status. So again, the stats that we just saw in the prior slide, the 87% at 20 years and 61% at the downside in 1 year, that's now plotted on the chart in relation to the thousands of other portfolios that we sampled for mean variance optimization. And so you can see that, again, samples A through E. And when I look at this chart, I look immediately at the current policy and the actual allocation, those red squares. And then visually, I just kind of draw a line up and see how high I can get in funded status without really compromising on the downside funded status. So really just a straight vertical line. And you can see that by going up, you can get closer to portfolio C, maybe in between C and D. But really, if we're looking to get all the way up to portfolio E, we would have to accept a bit more funded status volatility in relation to that. And so the optimal, in these next few charts, you'll see there's this purple arrow at the top right, or wherever it is on the chart, really showing you where we think, based on these metrics, the optimal portfolios are. So moving on to the next slide. So these next two charts go at this value at risk concept, where there's a probability of something happening and then a severity. And so on this slide, what we're showing you is the probability of a drawdown in assets of more than 10%. And then the x-axis shows you, if you do experience that drawdown, how large of a drawdown is it expected to be? And so not much of a surprise here. The lower risk portfolios, portfolios A and B, do show the best on this chart, not just from the probability of a 10% drawdown, but also when the drawdown is less than 10%, they're going to give you an expected smaller drawdown. So if we wanted to go to the next slide, this chart shows a bit of an interesting statistic, and I'll set it up briefly. But what we're doing here is trying to get a sense of what the funded status volatility is. Between now and 2040, how much do we expect your path to be volatile? And so what we're doing is we're drawing a straight line from the current funded status of 77% to 100% funded in 2040. And then what we're doing is looking at all these portfolio allocations to see how often are these portfolios expected to be below that path. And that's your y-axis. So we want a number there that's as low as possible. And then when you are below the path, what's the average funded status below the path? And so again, we want to have as low of a number there as possible. That's why the optimal arrow is in your bottom right. And so what I found interesting about this look is kind of the shape. It's got this interesting curvature to it where portfolio A doesn't show very well, and neither does portfolio E. It's really the middle portfolios that show the best. And the reason is because portfolio A has an expectation of 6.2% over 20 years. And the liability is expected to grow at that discount rate of 7%. So with a portfolio of 6.2%, it's just not growing as fast as the liabilities are growing. And that's why it just doesn't show very well. Whereas portfolio E has a higher volatility, so it tends to drift below that line more severely when we look at all the results. But the other thing that I noticed is even the portfolios that we've provided in the middle, the C and B and D, they don't necessarily do as well as the efficient frontier did. And so when you all get closer to selecting the risk profile that you are going after, we can look at these portfolios to see what's really driving this, and we can hone in on some of the causes. But when it's really this entire spectrum of risk and return, it's a little hard to glean from it what specific attributes we're looking for. So this is the last scatter plot that I'm showing, but the idea is that when we do select more granular risk return profiles, we'll come back to you with some more of these scatter plots to show you some comparisons of these portfolios that we'll recommend in the future. So if we turn to the next slide, and I'll turn this over to Steve to take you through some shock scenarios.
Great, thanks, Jonathan. And we're happy to take questions at the end as well, but I figured I might pause for a moment here if there's any specific questions people want to ask before we go into our final section.
I don't have anybody in the queue, Mr. McCourt. I'll pause for a sec just in case.
Great.
Okay.
So in this last section, I'm going to be going through some more traditional ways to look at risk and return in asset allocation policy. As Jonathan, I think, really crisply explained in his asset liability work. At the end of the day, what all of these charts and tables and data express is that there's a natural trade-off between short-term risk and long-term return. And you're looking at that trade-off and balance in various different ways. And these slides will show the same. The slide 17, we wanted to show one slide that highlights the impact of having a negative shock to the portfolio earlier on in the process. And we do that because most defined benefit plans today, including yours, have some degree of negative cash flow associated with them. You have to liquidate assets out of the corpus of your fund each year to pay benefits in excess of contributions. And that's a very normal position for defined benefit pension plans to be in. If those negative cash outflows become more significant over time, you can have a really interesting situation where the timing of bear markets and the timing of negative returns can impact significantly your long-term funded status. In your particular case, your plan's cash flows as they've been modeled are not that significant. So the impact of this timing aspect of long-term returns isn't as severe. That being said, we do highlight in this slide that as you go from more conservative policies to more aggressive policies, the impact of a negative event in year one is not just less impactful from more conservative policies in year one, but also impactful in future years as well. As if the market doesn't recover, you have less capital in your portfolio because of the cash outflows to fully recover your fund. So it's just something to be aware of when looking at more conservative and more aggressive portfolios. If you turn to slide 18, as part of our analysis, we do a risk budgeting analysis that allows us to categorize volatility across your major asset classes. The main point I want you to take away from this is in today's world, where interest rates are as low as they are, and plans are expected to produce returns as high as they are, every defined benefit plan, or virtually every defined benefit plan, is going to be relying on growth risk as a way to achieve returns. And so all of these portfolios have a high degree of growth risk associated with them. You know this. This is part of your investment beliefs that you're a long-term investor and can accept the volatility associated with growth. But I did just want to note that even the most conservative policies that we have listed here have a very high degree of growth risk associated with them. We turn to the next slide. Over the next couple of slides, we highlight a little more the potential downside impact of different asset allocation policies. We do this first by using a value at risk calculation. This calculation is, from a mathematical standpoint, represents in our modeling a 99th percentile outcome over a 1, 3, and 6 month period. And just to draw one example, based on our models, mix A would have in essence, a 1% chance over any 6 month period of returning negative 15%. Mix E, the most forward-leaning portfolio, would have a 1% chance of having a return of negative 18.7%. So this gets to the point that in bad markets, as you move from portfolio A to portfolio E, the severity of the downside increases. Slide 20 shows very similar data. This is what's called conditional value at risk. So this data will show the same pattern, but the numbers here represent the average return for all observations beyond a 99% confidence level. And the trend here is the same, that more aggressive portfolios in negative environments produce more severe negative results. On page 21, in addition to the modeling that we do, we also like to run policy portfolios through actual real world experiences, since models are just a reflection of the real world. This allows us to, maybe in a perhaps more tangible way, highlight how these different portfolios would have performed under capital market events that many of us have lived through in the past. And so the one that I'll highlight for you, because I think it's still most present in people's minds, is the global financial crisis, October 2007 through 2009. This is the second row. And this is the cumulative return over that 18-month period. Our estimate is that your current policy and your actual allocation, if we were to have a repeat of the global financial crisis today, would have a return of negative 23.7% to negative 25.4% respectively. Mixes A through E, you can see, would have an experience of negative 19.9%, so protecting a little more capital than the current policy, all the way out to an experience of negative 26.8%, which is a larger loss than we project you would experience today in a repeat. So, and we run this through a variety of crises, because not every bear market, not every crisis is the same. It affects asset classes a little differently. But you will see, as you kind of scan your eye across the page, more or less the pattern holds true, that in bad markets, as you move out towards mix A, the losses are amplified. To mix E, they're amplified. As you move to the left to mix A, the fund is protected more in down markets. So this, again, gets to the point that you're trading off short-term volatility for long-term return potential. If we turn 2 slides or 3 slides forward to slide 24, I do want to note, I'm not going to go through the details of it, but as part of this analysis, we do a liquidity stress test on your portfolio going out 5 years. Jonathan noted that all of the neighborhoods that we're looking at for risk do involve, to some degree, somewhat higher levels of illiquid assets. That's a combination of private equity, real estate, infrastructure, private credit. And so we want to make sure that the fund can support that level of illiquidity going forward, and our modeling provides us confidence that it will. If we turn now to slide 26, I'm going to conclude with a couple of statements. First, to reinforce what both Leo and Jonathan started with. Your very first investment belief is that strategic asset allocation is the primary determinant for risk and return of the portfolio. So when we're asking you to provide feedback on the right neighborhood, A through E to be in, it's a meaningful decision for the next many years for this plan. I also want to highlight that or reinforce what Jonathan said about risk. This analysis somewhat necessarily has to be a little more quantitative, but I do want to give the board comfort that as we go through the asset allocation process and work with staff, we are discussing and reviewing a host of qualitative risks associated with these policies as well. Things like liquidity risk, things like the level of confidence that we have in the fact that historical returns will actually be repeated in the future. So we believe that this analysis is a quite holistic one from a risk perspective. And my final comment is on this slide 26, the summary information to focus your eyes on are at the very bottom right of this slide in yellow shading, which is the expected return, the expected volatility. If you're going to boil down an incredibly complex set of information to two pieces of data, that's the 2 pieces of data that these portfolios can be boiled down to. The expected return represents the long-term return potential of each of these broad portfolios, and the expected volatility is a measure of the likely risk associated with each of them. And as you can see, and as we all know, there's no free lunch in the capital markets. Higher returns are associated with higher levels of risk. So with that, I'll conclude, and we're happy to take any questions that the board has.
Thank you very much. I appreciate it. Excellent presentation. Much food for thought. I do not have anybody in the chat queue. I'll open it up for questions or comments.
The only, if I may, Mr. Chair,
please.
The only comment I have, so did I heard you correctly that on a future meeting, you're going to spend more time on the different scenarios here? Because I'm not interested to see a portfolio D, but so that's going to happen when next month? Where are we in terms of drilling down into this presentation and others?
Yep. So in terms of timing, if provided we get sufficient direction to focus on one or two of these categories, we'll work with staff and come back at the next meeting with much more detailed recommendations that will have all of the target allocations for the sub-asset classes. So for example, within growth under category D, you won't just see the 53% aggregate amount. You'll see that global equities will have a certain percentage associated with it, private equity, a certain percentage, et cetera. And so that data underlies these today, but we'll be able to show more granularity and variety in those sub-allocations at the next meeting once we narrow down to a particular category.
Thank you. Mr. Grable, you wanted to weigh in?
Thank you, Mr. Chair. A couple points. One is, I believe it's in the cover note, but this deck was shared with Milliman, and Makita's been interacting with them. So I just want to assure the board that the actuaries are part of the discussion. The second is that we've been working towards Mr. Santos's point, and Steve really answered it, on the detailed portfolios beneath the different scenarios. And one of the things that I'm mindful of is the importance of building a portfolio based upon the beta, based upon what the portfolio is expected, as opposed to saying, yeah, we can't quite get there, but we're going to make up for that gap with alpha. We're going to, be that much smarter than the markets as a whole. Because I think this is a really important discussion to focus on the beta of the portfolio, the illiquidity, whether we can get to, if we hypothetically, say we want 15% in private equity, well, can we get to 15% in 3 years? And it's important to note that we're kind of at 13% today. So we're, over our target. So that may be easier than if we were to model, we're going to get to 20% within 3 years. So we're working very closely with the Makita team, and it's been, a really good, partnership focusing on all the key drivers.
If I may, Mr. Chair, so Mr. Grable, I appreciate your comment. Thank you very much for that. To me, it appears that D is the one who's going to get us closer to the 7%. But I heard Mr. McCord's statement that not being able to dig down, there might be some issues there that we need to stay away. So, Mr. Grable, I guess the question that I have for you is, one, do you feel that it will be a good idea to discuss or drill down on D, or do you have another scenario that you think it will be more reasonable to get us to where we want to be? Again, if I heard Mr. McCord correctly, he needs some type of direction, so that way we can do the full analysis and come back and determine what's the best avenue for us in terms of scenarios. So I'm sure we should be looking at maybe 2 or 3 scenarios that are reasonable. What say you in terms of that?
And thank you, Mr. Santos. And the Makita folks can attest to this. In some of the prep for this, I said, ultimately it's the board's decision. It's the most important decision the board makes, but if I had to vote, it would be somewhere around D. Because I think that it does not have too much illiquidity. They're numbers that we can reasonably get to within several years. The other thing is, in a low interest rate environment, increasing allocation to investment grade fixed income may not be the winning strategy. It was discussed earlier we're in a negative real rate environment. That may be a tough area for us to over allocate to, but we will come back with different scenarios about increasing returns, smartening our Sharpe ratio, so to speak, for the level of risk we're taking. Can we be more efficient? But I think that if I were asked to, give advice to the board, it probably is something around D.
Thank you for that, Mr. Gabriel. That means a lot to me in terms of my deliberation and confirmation of my conclusion after reading and hearing the presentation. Thank you.
Thank you, Mr. Santos. And I don't see anybody else in the queue right now. I know for myself, it's interesting to look at C, and you can get, a better return for just a tiny bit more volatility. Is there some usefulness, either Mr. McCord or Mr. Festino, to adding, besides D, some other option for us to consider that's either slightly more aggressive towards E or slightly more conservative towards C? Or is it better for our next meeting that we really kind of hone in on one category like D, that we can make some subtle tweaks if necessary?
I think there's flexibility to look at options around D. I don't think you need to constrain yourself at this stage to only looking at options that have the exact characteristics of D. So I think if there's some interest in looking at modestly lower risk positions, we can build that in for the next analysis as well.
Yeah, I would tend to agree with Mr. Santos. I think D is where I'm naturally gravitating towards. Any other comments, questions from trustees? Hearing none, seeing none. Thank you both very much.
Thank you.
We are moving on to our next item. Similar strategic asset allocation. This is 9B, related to the OPEB Master Trust. And again, before we kick it over, I'll start with Mr. Perez.
Mr. Knox, Mr. Chair.
Sure.
Any possibility of a break
Oh,
soon?
Sure. Why don't we take a quick break?
You have the largest bladder. That's all I have to say, Keith.
No comment. That's HIPAA protected information. Yeah, sure. Why don't we take a 5-minute break for the group, and we'll meet back at 10:32. See Mr. Kelly briefly. Let's see what else we have. See Mr. Jones, thank you. Can I get a quick check-in either from Mr. Green? I know Ms. Sanchez had to step away for a minute. Mr. Kehoe, Mr. Bernstein, if somebody could just chime in just so we know we have a quorum.
Hello.
Okay, thank you. Okay, now we are on to item 9B. This was the strategic asset allocation for the OPEB Master Trust. And Mr. Perez, I'll kick it over to you.
Good morning again, Chair Knox and trustees. The next item on the agenda, as you mentioned, is the second of 3 items today discussing the strategic asset allocation. So in this next presentation, Makita will cover the prospects of adding a liquid and alternative assets into the OPEB's asset allocation. So the main two goals of this discussion are to, one, evaluate the potential asset allocation ranges for liquid and alternative asset classes. And
Linda, I think you need to mute. Thank you. Sorry.
no, I'll repeat that. So the two main goals are, the first one is to evaluate the potential asset allocation ranges for liquid and alternative asset classes. And the second is to discuss the implementation options if these asset classes are adopted. So again, I do want to mention that this is not a recommendation, as this discussion will be used to guide the allocation options that Makita will bring forward at the next Board of Investment meeting. So with that background, I'll hand it over to Tim Filla and Alina Yuan from Makita.
Great, thank you very much, Jude. Good morning, Mr. Chair and members of the board. As Jude just mentioned, this is going to be part 2 of 3 on asset allocation for this meeting, and it's going to be focused on the OPEB Master Trust. At the previous meeting, we discussed some of the differences within the OPEB versus the overall pension fund and some of the reasons for that. And we highlighted that the size of the OPEB trust has now grown to over $2 billion, where we really think adding additional asset categories beyond just public markets makes a lot of sense at this juncture of that fund's growth. Jude hit on the 2 main goals of this presentation. I'll just add a little bit more color there. So in the previous one, we talked about shopping for the right neighborhood. So we're also going to be positioning the OPEB trust in a similar neighborhood, but this house is going to look a little bit different. Maybe it doesn't have all of the high-end upgrades as far as asset classes, but we're going to be trying to move more in that direction, as you'll see with some of the asset allocation scenarios. And I think the key points really are the items for consideration on why this still will look somewhat different. That comes down to some practical considerations regarding implementation, staffing, and various things that we'll talk about in this presentation. And again, all that we go over here is really going to be baked into what's going to be presented for the asset allocation options for your consideration at the next meeting. So with that, I'll turn it over to Alina to go through some of the different scenarios.
Great. Next slide, please. And one more forward. So here's an introduction to the scenarios. We show the current policy allocation broken out by the functional categories for OPEB compared to your 3 separate mixes. Mixes A, B, and C all add additional private market assets to the allocation, and that's evident through the bottom row of the illiquidity measure, which is increasing from left to right. For mix A, we wanted to show an allocation which maintains that same level of volatility or standard deviation of the current policy, but has a slightly increased expected return. And each of the additional mixes A through C produce a higher risk adjusted return, as shown by the increasing Sharpe ratios. Next slide. This slide shows more of a granular view of looking under the hood of each of the functional categories broken down. As you can see, when you're comparing to the current policy, the additional mixes have increased allocations in private equity, real estate, in terms of non-core private real estate, as well as core private real estate, illiquid credit as well. Next slide, please. Now we'll take a look at, similar as how we've done with the pension, we'll take a look at how these different policies would have performed through historical notable events. Mixes A, B, and C would have outperformed in all but 2 historical market scenarios, negative market scenarios. The first is the popping of the TMT bubble, which is the 4th down the line. This is the .com bubble. The current policy would have performed slightly better here given the policy's higher allocation and fixed income. And the second is the period of stagflation, which is second from the bottom row. And again, these scenarios really show that trade-off between that short-term volatility for long-term potential returns, because as you move right, these returns tend to have a little bit more of a severe downturn. We also added at the very bottom the COVID-19 market shock, which is the most recent market event on this slide through 2020, and we can see that mixes A through C would have all experienced that magnitude of the correction, but really to a lesser degree, all of the additional mixes would have been slightly more resilient. Next slide, please. Thank you. And lastly, we also wanted to simulate some stress testing to see how these different portfolios would react towards 4 different risk factors. We show changes in interest rates, credit spreads, currency fluctuations, and equity values. The mixes that include the private markets outperform the current policy in all but 2 scenarios, including trade-weighted dollar gains of 20% and a scenario where US equity declines 10%. And we can see that it's really the large equity market declines and the widening credit spreads that have the greatest negative impact on these portfolios. And next slide. And I'll turn it back to Tim to talk about some other items for consideration.
Great, thank you. I think all of these items are very important, so I'm just going to go straight through the list. The first one is, should we be including private market and alternative asset classes? We think the data shows the potential for improved outcomes as we go through time, notwithstanding the incredibly strong results that this portfolio has had by just only owning public market assets. We do think going forward, and when we look through scenarios, you do end up in a better neighborhood of risk-adjusted returns by adding these additional categories. The next one, should there be any caps applied during the asset allocation modeling? Here, again, the targets for these asset categories are going to be much higher for the pension, and we are trying to shop in that same neighborhood, but there are some real-life considerations. We think Mix B probably has the most achievable private equity target of 6%. Again, we're trying to implement these things in a 3-year time frame. So you're talking about taking vintage year risks. If you go much faster than that, buying at a particular point in a market cycle, there are some tools that you can use, such as secondary purchases, things along those lines. But we want to be realistic and make sure that we're establishing targets that we can get to during that 3-year implementation period. Some other real-world considerations regarding the overall resources of the master trust: doesn't have asset class consultants currently. So whether we want to evaluate that, or the board wants to evaluate how exactly we're going to be evaluating some of these additional investment options. The OPEB trust also doesn't have any dedicated staff, and LACERA staff allocates time as required. But as this portfolio gets increasingly complex, there'll be additional demands on LACERA staff, and there may be some additional evaluation required to figure out how all of those mechanics work as far as cost sharing, et cetera. There's also a significant difference in implementing a mature portfolio versus growing a private markets program. So it's difficult to utilize the existing research that LACERA's staff is doing for the pension to evaluate private market opportunities, because they may well be different at this stage of the OPEB's entry into those markets. So one thing that we've been discussing with staff as a potential way to implement this relatively efficiently, especially in light of these special considerations, is that you could use 1 or 2 asset managers that have deep expertise across these private market and alternative asset categories, give them discretion over implementing this, and then you would have the ability to go through, one manager and what would be something that looked a lot similar to your initial setup with LACERA's hedge fund program, where you relied on Goldman Sachs and Grosvenor to do a fund-to-funds type of an approach as you built up your internal capabilities to manage that program in a direct manner, which you do at this point now. So we think that is one interesting idea on how to potentially implement this as we go forward. On the next page, we can do a little bit of next steps. So we have received some feedback on everyone seems to be pointing towards living in neighborhood D. So we're going to use similar assumptions for the OPEB portfolio, and then we'll be utilizing some of these new asset categories under the hood, and you'll see the granularity in the OPEB trust in the same way that Mr. McCord said that we would see it in the next iteration of this presentation for the May meeting. And then once this all gets decided, we'll need to update investment policy statements, et cetera. but this will be following a very similar path to what we're going through with the pension trust at this point going forward. So with that, we'll stand for any questions, comments. We certainly welcome any feedback at this time.
Thank you. I have a couple of trustees in the queue. We'll start with Mr. Santos.
Thank you for that presentation. Probably this question should go to Mr. Grable and perhaps the acting general counsel, who hopefully is still on the line. So with regards to the cost associated with this portfolio, the way I understand it is legally, we need to separate, we cannot use any pension monies for the OPEB. And that's what I'm invoking the general counsel, acting general counsel, to correct me if I'm wrong with regards to that. And if it's true, then, Mr. Grable, we're going to have to, or I would love to see the breakdown of how we're going to divide all that cost with staff and things like that. And also with regards to the recommendation for the fund of funds, because I think that's what Mr. Fila, you were recommending, right? Or Makita's recommending that go through a fund of funds. We do have the expertise in-house. Wondering if we can use that expertise. Again, it goes back to how we're going to allocate the costs associated with that work from the staff. Anyway, those are the two questions that I have.
I'll go first. Yes, you are correct. The exclusive benefit rules limits us to not being able to spend money outside of the pension fund. You're correct.
Thanks, Shahana. The question about the fund of funds, and I prefer kind of the separate account mindset, because we wouldn't just subscribe to a fund of funds. Something would be more custom to us. That's something that staff that we have discussed with Makita. I think that we certainly have tremendous expertise across all asset categories in the investment office at LACERA. With that said, and there's one of the things that Tim mentioned is as our programs are very mature, sophisticated, and we're focused on niche strategies globally, and to construct a kind of core or initial foray into some of these strategies, it may not make sense to do those very specialist or niche type strategies, which means that it's almost twice the work for the team here. And this is something that over time we can add resources potentially subject to approval of both boards to focus more on some of the implementation with OPEB. But one of the things that we did explore a couple of years ago was, what Johanna was talking about, and Mr. Santos, your question is, well, can't we just simply unitize the pension and have OPEB invest in sleeves? And there's a clear benefit for the OPEB trust by us doing that, but there is no clear benefit for the pension by doing that. So, which means that we have to, in some sense, duplicate efforts. So this may be the best way to get there more quickly. It can involve some secondary purchases, and then over time we can add a greater level of sophistication to the OPEB plan.
I think Mr. Grable said that all perfectly. The only other thing that I would add is I agree that you have the in-house expertise, but in all of these private market categories, you also have outside consultants who represent the board's interest and verify the processes and procedures and the research that goes into all of the recommendations that staff ultimately makes. And in this particular case, there's no mechanics really for how they would have that additional level of support and how the board would be supported in those considerations.
Thank you, Mr. Santos. Your questions are done. Okay, perfect. Thank you, Mr. Bernstein.
Thank you, Chair Knox. Thank you for the presentation. In terms of input, and there's something that comes up with OPEB, which because of how it's structured, the Board of Retirement gets independent briefings on. And it relates to this question to me about whether we want to go more into things like private markets and alternative assets. And it's that, as I understand it, the county retains authority to raid OPEB if they choose to in a way that doesn't apply to the pension. It's part of why the rate of return is set lower. The challenge of being supportive of things like private markets, which are much longer term investments usually, is that to some degree, the ambiguity requires us to maintain a greater liquidity availability. And I don't think that we can resolve this if I'm understanding it correctly, but I'm wondering if we should be in, or if we are in communication with the county about the desirability of them committing to locking down these funds for a longer period of time so that we can have a greater deal of certainty when it comes to placing investments that have a longer horizon on them. I guess, John, that's sort of a question for you.
Thank you, Mr. Bernstein. My understanding is that this duty of asset allocation for OPEB is delegated to the Board of Investments. And legally, Johanna, correct me if I err, if I don't step precisely in the right side or from the wrong side of the line, but it's the Board of Investments is the named money manager of this fund. We do inform the county, but it's the decision of the Board of Investments in terms of how these funds are apportioned across asset categories. And as it relates to the potential need for liquidity, I think that that's something that we should certainly be mindful of in terms of not constructing a portfolio that is like an endowment of 70% illiquid for precisely that reason. But I think that this is something in terms of how I've been instructed thus far is that it's the Board of Investments who makes the decision as to how these assets are apportioned. And as a good partner, we should communicate that those decisions to the county.
So John, when we talked about this at the Board of Retirement a month or two ago, and the question came up of why the rate of return is lower on OPEB, the anticipated rate of return is lower on OPEB than on the primary trust, the answer that was provided was that we need to be able to be flexible about having greater liquidity because the county can pull money out more easily. If that fact stands, then in our advisory capacity on where we should be doing allocation, it does become important to be more cautious about long-term investments. If the county, who has not indicated in action any need to pull money out, is willing to commit to a greater certainty that the money can stay in place, it's easier to advise staff to be more aggressively looking into long-term horizon investments.
Chair Knox, can I make a comment?
Please.
Chair Knox and Member Bergenstein, the county, since I've been here and to my knowledge, has never asked to pull money out of the OPEB. However, it's been our position that if they did ask for money, that obviously we would make the distribution to them. We did have the courts, however, ask for money at one point. So just so you have that knowledge in the background. As far as it goes from the asset allocation, the option mixes that Makita has put in front of the board today, and this is what we're trying to get a feel of how much liquidity or illiquidity the board would be comfortable with. So if we took the OPEB trust into having, say, 15% of the plan is illiquid, I still believe that we would have sufficient liquidity to meet any strange scenario that may happen that the county would ask for a distribution from the plan. Just wanted to give that kind of background for some color.
Thank you, Jude. And $2 billion, for anyone who's been to IFEVP, $2 billion is a real pension fund for many people. It's just in the perspective of our primary trust that it looks small. It's a significant accomplishment. It's a significant amount of money. And I would be in favor of sort of this shift. But again, I keep coming back to the fact that we have a lower expected rate of return on OPEB. And the only logical reason for understanding that is because we believe that we need greater access to the money more quickly. If that's not the case, then our rate of return, frankly, is off. But in terms of allocation, I'm certainly supportive of the idea of moving towards some more interesting, more long-term investment opportunities.
Thank you, Mr. Bernstein. I have Mr. Kelly in the queue, but I have Mr. Grable. I think you were going to provide commentary. Mr. Kelly, are you okay with Mr. Grable going first?
It's fine. Yes.
Thank you, Mr. Kelly. One thing for us to recognize is that liquidity and illiquidity are somewhat fuzzy, in that when markets seize, like they did a year ago, liquid asset categories were potentially illiquid. Our most liquid asset category of cash had limited liquidity at the time. So, and at the other pole, what we call illiquid assets aren't totally illiquid. You can sell them. Maybe you have to take a slightly larger haircut to carrying value, but you can always, not always, you can most of the time get some liquidity for things we call illiquid. And there are times where that which we call liquid may not be that liquid. So I think that that's why, for going back to the prior presentation where, scenario B or portfolio D rather, was in the 30-ish percentile, that gives a wider berth than portfolio E in terms of giving us more liquidity optionality. But I just think it's important for us to realize that it's not a pole, liquidity and illiquidity.
Fair point. Thank you very much for adding that.
Thank you, Mr. Grable. Mr. Kelly?
Yeah, I wanted to just recommend that perhaps we just need a refresher memo, maybe from council on the county's ability here to liquidate this pot of money. My recollection is that at the very beginning, the county had set some, through a formal memo, had set some constraints around the investments of this money to be liquid, but that was also before the Board of Investments became the sole, and I think John's right here, the Board of Investments retains the sole authority to set the investment policy for the OPEB trust. And the issue of the county taking the funds out is interesting to me because it's an irrevocable trust. I don't know if the court was set up in the same way. But maybe since we have new members on the board, and certainly I was away for 2 years, we could just have I think it might be prudent to have a refresher memo from council on the issue of the board, the role of the Board of Investments, and then also the county's ability to liquidate these funds on an ongoing basis. I think that would be prudent.
Yes, we can do that. And I haven't looked at it in a while either. So yes, we can bring that back to you. And that would be a good refresher since it's been a while. Mm-hmm.
Thank you. And I don't see anyone else in the queue. I had a couple of points, and I think one of them just again gets back to the county and whether or not if the discretion lies entirely with BOI, fine, great. But is there still some communication back to the county in terms of what is going to be changing and what that might result in, should they ever, need to tap it, that type of thing. I would think there'd be some need for follow-up. And then the other piece I was going to mention, and I think it was mentioned by Makita in terms of the mechanics, at what point would we transition this to internal staff, and I'd just be curious how that transition would go. And is it just, are we going to set a target amount of, okay, once it gets to X size, then we're going to really start to bring stuff in-house? And I just be curious how we would plan for that. And should we seek some sort of consultant or guidance on just to prepare something that, okay, this is what it looks like as it gets bigger. This is how we're going to begin to transition it. I don't know if there's administrative issues like whether or not, OPEB needs its own, contracts with certain folks, or, if there's concerns over prioritization of investment opportunities for, LACERA versus OPEB, that type of thing. It'd be interesting to see some of those conflicts and how we disposition those as we went along. So that one was more of a comment than anything. Okay, anybody else have any questions or comments? Okay, thank you, Mr. Perez and Team Makita.
All right. So Chair Knox and trustees, this is our third and last item today discussing the strategic asset allocation. In this next presentation, Makita will outline potential structural changes that have already been discussed with the board over these last few months. And then the objective of this discussion, as with the previous item, is to get the board's feedback, which will then be used to shape the allocations that the board will see at the May meeting. And so with that, I'll hand it back to Tim Filla and Alina Wong.
Great, thank you, Mr. Chair, members of the board. As Jude just said, this is the last item on strategic asset allocation for the day. This one also is not a recommendation, but your feedback is going to help color exactly what goes into the recommendations that'll be put forth next month. These items that are contained in this presentation have all been discussed at previous meetings, and we'll go into them in a little bit more detail. Again, barring any feedback, we will be utilizing these in shaping the asset allocation recommendations at the next meeting. So with that, could you just move forward one slide here, Cindy? So I think I kind of captured all of that on this slide, and Alina is going to be going through each one of these potential changes again, which we have presented at other meetings, and then also summarizing the overall supporting rationale for your consideration. So with that, I'll turn it over to Alina and she can go through some of the details.
Thanks, Kim. Next slide, please. Great. So the first potential change is considering consolidating the underlying credit strategies into both liquid credit and illiquid credit. So essentially high yield bank loans and EM debt would be consolidated into liquid credit, and then illiquid credit would just stay as is. And the rationale here is this new framework is consistent with the other asset categories, such as growth, where we have that breakdown between global equity and private equity, which are already separated. And having this specific distinction between illiquid credit and liquid credit will help to increase implementation flexibility. And even though it is removing this layer of complexity at the bird's eye level, when you're looking at the individual sleeves of the functional categories, the portfolio risks will still be managed at the granular level, and the regular credit structure reviews also support that successful implementation and monitoring process. Next slide, please. The second change is to real estate. The proposal is to break out real estate. Right now, core and value-added real estate live in a single sub-asset class under real assets and inflation hedges. So this potential change is to separate the two and move value-added real estate to the growth category with opportunistic real estate, and to combine both value-added and opportunistic and rename it as non-core real estate. The rationale here for moving value-added real estate is really because the value-added real estate has that higher 20-year expected return of about 7.7%, and it's more representative of an asset that would live in the growth category, whose primary role is really to be the driver of long-term total returns for the fund. Next slide, please. This is the third potential change, creating that fifth functional category called overlays and hedges. This is a concept we've introduced at the December BOI, and this fifth category would be given a 0% target, so there'd actually be no impact on the strategic asset allocation. Essentially, utilizing this separate reporting category for overlays and hedges can improve LACERA's ability to perform performance attribution at each category level without having that those currency value fluctuations impacting asset category returns like the currency hedge currently does with growth. Next slide, please. The fourth change is consider adding opportunistic green strategies as an additional component of the natural resources allocation. Opportunistic green strategies is actually a new asset class, which Makita added to our capital market assumptions this year. It essentially includes exposure to your traditional renewable generation strategies, but also includes decarbonization, recycling, ESG, and impact-oriented strategies, and strategies that really focus on transitioning to a low carbon economy. Opportunistic green has a 8.8% 20-year return, which is slightly higher than your private natural resources. And including this asset class as an additional strategy does provide LACERA with that additional tool to integrate climate awareness into the portfolio, and also provides an opportunity to both improve diversification and enhance returns. Next slide, please. And finally, this is the last proposed change, is to add long-term US Treasuries as an explicit asset class and an additional crisis risk offset strategy within risk reduction and mitigation. So LACERA also, including long bonds, would give LACERA an additional way to protect the promised benefits. LACERA already uses and implements crisis risk offset strategies within their hedge fund portfolio, but currently there is no explicit target to long-term US Treasuries. And with the continual global precedent of low interest rates, long-term Treasuries serve as an efficient risk mitigator because they have low correlation to equities during volatile markets. So having an explicit target for long bonds would be beneficial. And that summarizes all of the 5 proposed changes. Tim, would you like to take it away with closing remarks?
Yeah, so here would just welcome any feedback if anyone has any of these. Again, we have discussed these at some past meetings, and we've worked with staff on kind of going through these recommendations as well as some of the other asset category consultants at previous meetings. So we're happy to take any feedback. And just as far as next steps on this, these will be baked into all of the asset allocation recommendations for the pension that come forth next month, unless there's significant feedback that we want to limit some of these changes.
Thank you very much for the presentation. I have Mr. Santos in the queue.
Yes, thank you very much. As you stated, Mr. Perez, we have been receiving briefings for the last several meetings, and I reviewed it again, the reading, the writing, as well as the presentation. I don't see any issues to me, and as such, I am supportive.
Thank you very much. I do not see anybody else in the queue. Any last comments or questions before we move on? Okay, thank you very much for the presentation.
Thank you.
We will now move on to 9D. We have First Amendment training. Ms. Fontenot, do you want to kick things off and introduce our speakers?
Yes, thank you, Chair, members of the board. Yeah, we're going to change subjects altogether here, talk about the First Amendment training. I'm happy to introduce Ashley Dunning and Peter Mixon. They're your fiduciary counsel, and we're very lucky to have them. They have over 20 years each of experience of advising pension funds. So yeah, without anything more, I'm just going to say that they're going to talk to us about your First Amendment, freedom of speech, and then how it intersects with your fiduciary duties. And I'll let them take it away. Thanks.
Thank you, Johanna, and good morning, members of the board. Can you hear me?
Yes.
Great, thank you. My name is Ashley Dunning, as Johanna mentioned, and my partner, Peter Mixon, should be here on the video somewhere. Today we are speaking, there you are, good. Today we're speaking, as Johanna mentioned, about free speech rights and fiduciary duties and the intersection between the two of them. The title of our presentation is free speech rights and fiduciary duties, a governance challenge for retirement system trustees, because that's really the point of this presentation, to talk with you about the intersection between these two legal principles and how that interacts with your responsibilities in governing the Board of Investments in this case. Some of you who are attorneys will be able to receive continuing legal education credit for this, but in order to do so, you need to write down the code I'm going to give you orally right now. This is a new requirement of virtual trainings. The code is 141. And at the end of the presentation, you need to send that code to an email address that I'll give to you, which is nossamanprofessionaldevelopment@nossaman.com. So the code again is 141, and you send it to nossamanprofessionaldevelopment@nossaman.com, and you'll get 30 minutes of CLE credit. All right, so with no further ado, if we can turn to the next slide, please. So as I said today, the presentation today focuses on first your fiduciary duties. So as you know from all of your training in this area over the years, or some of you are newer to the board, a more recent training, public pension trustees owe duties of loyalty and prudence with respect to all of your activities relating to LACERA. We also today are talking about free speech fundamentals, and we'll go through those in basically the first 4 slides. We're going to do a really quick overview of free speech principles. There's a much more detailed legal analysis for you if you would like to spend some time with it. That's been provided in a non-privileged memo that's included within your materials for today. We're going to try not to spend too much of our precious 30 minutes together today on the first 4 slides, because we really get into the meat of this on slides 7 through 12 in terms of the fiduciary and governance challenges that arise in the context of this topic. But just in terms of this overview, please note there are certain forms of speech, as you probably all know, that are protected. So we've listed those here: artistic, symbolic, commercial, political, government speech. There are other forms that, as you know, are not protected: defamation, fraud, obscenity, incitement to violence, and other forms of speech are just simply not protected by the First Amendment. There's also an important overview concept here that we're going to delve into, which is that statutes may regulate protected speech in certain contexts. And the way in which courts analyze that is by weighing the governmental interest involved. And the really seminal case on that is the Königsberg case involving an individual who was applying to be admitted coincidentally to the California State Bar, and was asked about whether he was a member of the Communist Party. This is in the late 50s, early 60s, and he refused to answer that question. So that's a important sort of landmark case in this area. Today's focus, though, is on trustees' fiduciary duties and their rights of free speech in the context of those fiduciary duties. Next slide, please. And Peter and I are going to go back and forth here a bit on our presentation, and we've worked out who's handling what. So now I'll turn to Peter.
Thank you very much, Ashley. It's also great to be here this afternoon. Thank you very much to the board for this opportunity. Okay, before we get into sort of the nuts and bolts of First Amendment rights and individual governmental speakers, we wanted to touch on the general rules regarding expenditure of public funds. And in general, government agencies, when they speak as an agency, for example, LACERA officially speaking, they may speak freely on items of public import, provided that they don't, flood the marketplace, so to speak. However, there is an exception for expenditure of public funds in supporting that speech, and specifically to influence the outcome of an election. So this case, Stanson versus Mott, It's a well-known case. The court held that unless there is very explicit and very specific legislative authorization for a public expenditure of public funds to promote one side or another in an election, that those expenditures are barred by the California Constitution. On the other hand, if there is a general authorization in the statute that provides for communication of the agency's business to the public, that will support a, quote, fair presentation of information relating to the electoral issue. However, it will not support expenditure of public funds on what are called, I think, electioneering activities in favor of one side or another. So advertisements, floats, publication of pamphlets and that sort of thing. This is a well-known doctrine, and I think your policies already touch on it, but we wanted to bring this up as well as part of the presentation. So next slide, please.
The next slide deals with another well-known case in the First Amendment space, Garcetti versus Ceballos. An initial reaction to this may be that it deals only with government employees. We think that it has a little bit broader applicability, and therefore using it as a basis to frame the discussion today. There's an important principle expressed in Garcetti that we've quoted in this first bullet point, which is that when a citizen enters government service, the citizen may, by necessity, may accept certain limitations on his or her freedom. And as you all know, by entering public service through your participation as a trustee on the LACERA board or boards, you have by necessity accepted certain limitations upon your freedoms. The most frequently litigated example, as I mentioned, is the public employee speech example. And in that context, the US Supreme Court has developed a two-part balancing test that we have identified on this slide in the third bullet point, that the court will weigh the interest of the public employee as a citizen, so as distinguished from their role for acting on behalf of the government, but as a private citizen, to comment on matters of public concern on the one hand, both of those being important, acting or speaking as a citizen on a matter of public concern. And then on the other hand, the interest of the government, and in this case, in Garcetti, talking about the government and its role as an employer to promote efficiency and effectiveness of the public services that it performs. We're going to talk a little bit more about this balancing test, as I said, in our later slides, and why we think there's applicability to this discussion. But first to note that the Garcetti analysis in analyzing free speech rights of California public employees has been specifically adopted in this Kay versus San Diego County Public Law Library case that we cite here. Public pension trustees accept fiduciary responsibilities in assuming a role on the LACERA boards. And therefore we conclude that there are corresponding free speech limitations that apply to you within the context of a balancing test that we will discuss further. Next slide, please. So I'm continuing with this one, Peter, right? So yes. The application of this government speech balancing test to elected officials, so members of the board of supervisors, for example, mayors, etc., has resulted in a split of authority in federal courts as to whether that the Garcetti balancing test applies. The Supreme Court has not yet addressed the issue. And importantly, for purposes of this discussion, none of those cases address a public fund trustee's fiduciary duties in this context. And so what we are urging is that there be a consideration of this balancing approach when thinking about LACERA's interest and the board's collective interest in ensuring that your boards meet your constitutional responsibilities, your fiduciary responsibilities, when considering each of your individual free speech rights as private citizens. Noting that restricting speech that owes its existence to those professional responsibilities that you have, those fiduciary responsibilities, does not constitute a violation of your individual free speech rights. Next slide, please.
Ashley, one comment.
Yes. Trustee
do wanna
Santos, I
note-
believe that was, or
Yes,
no, was that
Trustee-
Trustee Kelly? Yes.
Yes, Trustee Kelly. I did want to note that there are 4 members on this Board of Investments who are elected. It's not just the County Board of Supervisors.
Who are elected to
Unfortunately-
this, who are elected officials?
Yes, to this board, some by general members, safety members, and one by retiree members.
Thank you for that question. We referenced that topic in our more comprehensive memo. The applicability of an election to this board by a safety or general member versus election by the general populace to a position, say as a member of the Board of Supervisors or some other position such as treasurer of the county, is not clear, whether that would necessarily translate. Moreover, even when we're talking about an ex officio member of board or an appointee from the Board of Supervisors who sits on the Board of Retirement, they're taking on a fiduciary hat that may substantially moderate any applicability of the analysis that could support not applying Garcetti to an elected official for more general purposes. But I appreciate that question and comment.
So that's actually a very good segue into this next slide, where we're going to talk about a couple of cases that dealt with the intersection of fiduciary duties with free speech rights. And our conclusion is that the fact that an individual who's a public official has free speech rights does not avoid or obviate their fiduciary duties based on those rights. In the 2 cases that we've highlighted here, in SNAP and ASKU, illustrate that principle. So in SNAP, really quickly, dealt with a former CIA agent. And at the time the individual joined the agency, joined the CIA, he signed an agreement in which he agreed to be a fiduciary to the agency, as well as not to publish any books or other public materials without the prior consent of the agency itself, when the book dealt with his experiences at the agency. Well, what did he do? Of course, he just went ahead and published a book about his life and times as a CIA agent without getting the prior consent of the agency. And so the CIA sued him for breach of fiduciary duty, among other things. And the United States Supreme Court upheld that case and that lawsuit, and not only held that he could be sued for violating his fiduciary duties, but also that the profits from his book may be held in what's called a constructive trust for the benefit of the CIA, because that was the remedy that the court imposed for breach of those fiduciary duties. And all of this notwithstanding the individual's First Amendment rights. The second case is ASKU. In that case, it didn't deal with speech, it dealt with another First Amendment right, and that is to the free exercise of religion. There is a doctrine in the federal courts that the court system will not generally get involved in disputes involving organized religion, the church in this case, when it deals with the practice, the customs, the organization of the church. However, in this case, the individual sued the church trustees for breach of fiduciary duty for self-dealing with church property. And the court held, notwithstanding those First Amendment interests, that individual could proceed with their breach of fiduciary duty lawsuit and go ahead and have the opportunity to prove up damages and prove breach of fiduciary duty. So these cases for us, really, I guess, hammer home the concept that we talked about. And that is, even though an individual may have or does have First Amendment rights, when they take on fiduciary duties, particularly in a public context as a public official, that the courts will enforce those fiduciary duties, notwithstanding countervailing First Amendment rights. The final case we're going to talk about here is Phelan. This is a little bit different, but we also think it's relevant to our discussion here today. In this case, there was a member of a community college board of trustees who decided, an individual trustee, who decided to take out a full-page advertisement in the local newspaper that was opposed to a bond issuance that previously the board had voted on to support. And not only did she say, as a trustee, she opposed the bond issuance, but she criticized the board for taking a pro position on the bond measure. And so subsequently, the board decided to censure this individual trustee under their governance policy, and also adopted a motion reprimanding the individual for that violation. The individual trustee decided to sue all the other trustees, as well as a couple of individuals, for violation of her First Amendment rights, because she said she had a free speech right to post that ad and to criticize the board. The court said not so fast that in these circumstances, the right to free speech was not injured by the board's actions, but that by adopting a censure and reprimand action, the board very possibly have their own First Amendment rights to express their own opinion about the member's conduct. But even more importantly, that those kinds of actions do not rise to an injury of the individual trustees' First Amendment rights. Next slide. So just this slide is really to sort of sum up our legal conclusions that we've talked about. First of all, as I just mentioned, based on these authorities, we believe there is no free speech exception to the fiduciary duties owed by public pension trustees, that LACERA board members, when they voluntarily enter government service as trustees, they take on those responsibilities, and their actions, including speech, within their duties, are subject to their fiduciary obligations. Second, that all board members are subject to reasonable LACERA board governance policies that may at least potentially restrict their speech. These governance restrictions reflect the collective decision of the boards that are applicable to all co-trustees and are very likely a form of speech themselves. So as Ashley talked about in a little more detail, an individual trustee's interest in free speech will be weighed against the interest of the boards in having the board members effectively govern themselves, both individually and collectively, consistent with their fiduciary duties. And this balancing of interest must include the fiduciary responsibilities of all board members that they owe to the members of the system. Next slide.
Okay, so that then takes us to this governance framework that is the way in which we think it is most useful to discuss the intersection of these various rules. So first of all, the fiduciary duties that are owed by a prudent LACERA trustee, in fact, apply to all statements that you each make as trustees when you're speaking as trustees. And that statements by a trustee or any of you as a private citizen may still be subject to a balance between these free speech rights we've discussed and the interest of LACERA in meeting fiduciary responsibilities. Therefore, when one of you may speak and identify yourself as a LACERA trustee, but disclaim that you're speaking for LACERA and say you're simply speaking as a citizen, it may not always be enough to have made that disclaimer, because the reference to LACERA in that context necessarily implicates your fiduciary role. There's no removal of your fiduciary hat, if you will, when you are identifying yourself with LACERA in your statements. Moreover, if you're making a statement about a LACERA matter, even if you don't identify yourself as a trustee, you remain a trustee. And to the extent that your statements are having an impact, a negative impact on the fiduciary mission of the system, that also implicates your fiduciary responsibilities. And because of that, we conclude that the board's ethics and fiduciary policies may reasonably govern the content and manner of trustee speech to the extent that the boards choose to adopt or expand upon those sorts of policies. Next slide, please.
So in this slide, we're going to talk briefly, try to apply some of those principles to some examples that we've laid out here. First, trustee statements made from the dais are clearly subject to fiduciary obligations. And so this obviously doesn't mean to stifle debate. In fact, to the contrary, informed decision-making requires vigorous debate and advocacy, but within the mission, the fiduciary mission of LACERA. So trustees, the second point is trustee statements made to the media or in public speeches on LACERA matters, even as a private citizen, either may or will likely be construed as statements of LACERA representatives. Why? Because when the individual identifies as a trustee of LACERA, that infers some official status. And we've certainly seen that in real life. But beyond that, statements of personal opinion, even when they're identified as such, when they're about LACERA matters, they could have an impact on the retirement system with direct or indirect consequences. And finally, the sort of worst example, I guess, is disparaging or unprofessional comments about the organization. It clearly raises the risk of reputational injury for the organization. So our recommendations are the trustees should consider the impact, whether direct or indirect, when speaking or signing written statements about matters that LACERA is interested in, or about LACERA matters. And to further good governance, at least consider discussing these statements with the board chairs, the committee chairs, the CEO, the CIO, or the chief counsel in advance to hash out whether there is an indirect or direct consequence to the organization or to the mission of the organization to provide retirement benefits, and whether or not those statements implicate the individual's fiduciary duties. On the other hand, trustee statements on topics unrelated to LACERA business are far less likely to implicate the fiduciary mission of the system. And again, so thinking in advance, how will the statement, again, to the public or to the media how will that, affect the governance of the system and its ability to meet its fiduciary responsibilities? Next slide.
The next two slides focus on the two existing LACERA policies that address communication in one form or another. And we went through those to identify what is said, and then perhaps also to allude to what is not said for purposes of encouraging this board during this discussion to comment on how you might wish to proceed with this topic or not to address the governance challenges that are created by the issues we've been discussing. So the first one identified here is the media policy. And the stated purpose of that policy is to ensure that both boards' policies are accurately transmitted and explained to mass media representatives. And it's stated as a guide for communications with all outside parties. So although it's a media policy, it doesn't necessarily limit its applicability to communications to the media, but also could potentially address other contacts, such as presentations that are made, interviews with any third parties. It has pretty soft language, if you will. Board members are encouraged to refer media inquiries to staff. It doesn't say that they are required to refer media inquiries to staff. It states that board member responses to media inquiries should use discretion and should limit the discussion to formally approved board policy. But again, it's not a directive or a mandate, it's an encouragement. It states personal opinions and speculation about board member or staff motives, quote, are to be avoided. Again, it's passive tense and not directive in any way, except to the extent that it says that personal opinions regarding LACERA and its business must be clearly identified as such. So that is a mandate. It also says that any media contacts will be reported to the board, but it can be an after the fact report. And board member contacts with outside parties concerning LACERA, quote, should be conducted in accordance with the intent of this policy. Again, very non-directive, soft encouragement language. So the question here that we ask in a later slide is whether this board believes that's enough. Has that been sufficient as a way of managing the governance challenges that arise in connection with communications with outside parties by trustees? I see a question here, and through the chair, would the chair like me to us to respond to questions that we see in the chat?
You can. I noticed Mr. Jones had typed in his question. I have a queue of a few trustees that requested to speak at the end of the presentation. Mr. Jones, I think you're okay posing that question at the end as well, correct?
Yes, I can wait till the end for sure.
Perfect.
Thank you. All right, next slide, please.
So the other policy, the other LACERA policy that we want to discuss briefly here today is in the Code of Ethical Conduct. It is in the part dealing with political activities. First of all, no LACERA funds, property, logo, or other resources may be used to support personal political activities. I think that's a nod to the Stanson case we talked about a little bit earlier. Board members and staff may not use their influence or their position to secure a vote or for other support for a political campaign. And finally, board members and staff, quote, may use their LACERA position to identify themselves when making an endorsement, provided no statement may be made or action taken directly or indirectly indicating that the person represents LACERA in making the endorsement or that the endorsement is supported or represents the position of LACERA unless this information or providing this information has been authorized by the boards. Next slide.
All right, so this is our final slide, and then we'll take questions. And I see we're a few minutes from our 30-minute mark. So I'll take a guide from the chair about how you wish to proceed in terms of timing. But just very briefly, the governance consideration discussion questions that we urge the board to consider are: number one, whether your current policies are sufficiently clear so that all of you understand your responsibilities and your compliance obligations with respect to your fiduciary responsibilities in particular, and the intersection between those and what you may say to third parties about LACERA business. Are the interests of LACERA and its governing boards in effectively functioning, in being an effectively functioning organization sufficiently identified in those policies and otherwise? Have the fiduciary duties of the boards and of each of the members of the boards been sufficiently considered? In addition, do the policies reflect and/or respect the roles and responsibilities both of trustees and of executive staff? What role, if any, should your board chairs have with respect to this? Your committee chairs, your CEO, CIO, or chief counsel, in consulting with board members in advance of the member making public statements? And I saw a note on transparency, and I'm just going to quickly make a note here. Transparency is another consideration. Efficiency is a further communication, as we know that the Brown Act and obligations of transparency relating to communications of a quorum, of a committee, or of a board restrict the way in which you can be nimble with respect to certain types of communication. So you have to be careful when you are deciding with whom one speaks about these matters, so that you don't inadvertently violate an open meeting law requirement. But as you also know, that as trustees, if you're having communications with the CEO or CIO or chief counsel, that does not implicate open meeting laws. You can have those communications with staff as long as you don't have a quorum of a committee or of the board engaging in a serial communication about the topic. What role should the board chairs or the boards themselves have in enforcing policy requirements? Peter mentioned earlier the example of censure having been invoked by a particular board. That's not something that we've observed the LACERA board doing, but the question is, what is the enforcement policy, if any? And then any other questions that you may have. So with that, those are our prepared comments, and we're happy to respond to questions.
Thank you very much. Excellent presentation. I have Mr. Santos, followed by Mr. Jones, and then Mr. Kelly.
Thank you, Mr. Nats. In the context of trustee elections, as it was mentioned earlier, several of us are elected. Now, let me just give you a hypothetical. Can you hear me? Because I think my headphone is running out of juice.
I can hear you. Thanks.
Okay, good. So just to give you a hypothetical, so I was in an election. I was running for the Board of Investments, or re-election for the Board of Investments. So, I don't know, about 10 years ago, and or maybe longer. And I was criticized by my opponent, who happened to be a trustee of the Board of Retirement and had been a trustee of the Board of Investments for many years. And so this particular individual, during the campaign against me for the Board of Investments, he accused me of investing like if I was gambling money because I supported hedge funds. We had extensive discussions about hedge funds for many years. And this particular individual was totally against hedge funds. So anyway, during the election, he criticized me for voting for hedge funds and also LACERA for adopting that strategy. Certainly, I believed at the time that I had the right to explain my position to the members, to the voters, because the accusations were inaccurate. So in that context, certainly I was a trustee, or still am obviously, on the Board of Investments and had a need to explain my position as to why I voted for hedge funds. So the question is, what happens in a situation like that? I mean, let's assume that in the future, I haven't seen a need to do that, but in the future, I need to criticize an action that the board took in doing an election campaign or defend the position. Certainly, I have First Amendment rights to do that, even though I'm an official with LACERA.
Well, that's a very good hypo, non-hypo, Trustee Santos. And it implicates important principles that we've discussed, because as you know, on the one hand, you were a current trustee of the board when you were making those comments, but you were also engaging in a campaign to be reelected. So you retained your fiduciary responsibilities to speak prudently and consistent with your duty of loyalty, but you were also advocating on behalf of your own campaign to set the record straight in your view about your prior votes. Peter, you were about to say something. I've just set the stage, but if you'd like to weigh in, go for it.
I think that first of all, you are more than obviously just a candidate, right? As Ashley mentioned, you're a board member. So I think that your speech, even in the context of an election, would still be governed by a reasonable board governance policy. And I think that certainly defending yourself against accusations is not the sort of thing that we're talking about that the board governance policy would preclude or prohibit or anything like that. Particularly if you're defending them, in terms of your actions that you took as a LACERA board member and defending those actions. I think where the rubber may be a little bit more hitting the road, a little bit more difficulty, is in criticizing the organization or criticizing decisions that were made by the organization. And I think that would still be, that speech would still be within the context of your position as a trustee and a fiduciary. And so to some extent, this gets down to a judgment, call an informed judgment by the fiduciary, taking into account their responsibilities to manage the system, as well as to run for office. And I think that you are not going to lose your fiduciary responsibilities just because it's an election. And so I think again, considering the import of your opinions or your statements or your speech and its effect on the overall, management of the organization is important. And I think that, again, disparaging comments and unprofessional comments, I think those are going to run the risk of reputational injury to the organization itself. And that should be considered before speaking.
What I was hearing from Trustee Santos's hypothetical was that another person made a disparaging comment that would not be protected speech. Trustee Santos sought to set the record straight by defending votes that he had taken. My thought on that is that an appropriate forum and mechanism for advancing that response would be through some form of a candidate statement. And to the extent that LACERA permitted candidate statements and vetted them to ensure that there weren't disparaging comments in them, but rather were opinion related to the platform of a particular candidate, then that should be just fine. But that vetting is important by your CEO or CIO or chief counsel or a combination of them to ensure that the interests of LACERA members and beneficiaries and the duty of prudence in terms of the management of the organization is maintained. Does that respond to your question, Trustee
Just
Santos?
one quick comment that I moved on and I will shut up is that, well, in terms of referring to either the CEO, general counsel, whoever, or the chair in a situation like that, it could implicate the CEO getting involved in my election because, or let's say the CIO in my case, with regards to the hedge funds, if the CIO was, again, 10 years ago, to, well, write something or had a discussion with me that will favor my position, it could implicate that he's getting involved in the election. So it's something for us to think about and saying that we need the answer right now, but it's murky.
You're right that it would have to be fair in terms of how candidate statements were handled between various candidates. Yes.
Yep.
Thank you, Mr. Santos. Mr. Jones.
Yeah, good afternoon. Thank you, Mr. Chair. Just had a general question in kind of the good governance kind of, ethos of transparency that's through there, right? What's the nuance, right? Is it okay to talk matter-of-factly about the dynamism of, certain conversations or content that's not, obviously violating confidentiality? Like where does if there is such a thing as a bright line, where is the line as it relates to kind of transparency in a small d democratic way in terms of your speech? Is there any point where there's conflict or not really?
I don't think there should be conflict because the transparency that exists in the governance of LACERA should occur through your public meetings and your vigorous debates at your public board meetings or public committee meetings. And there should be vigorous debate and discussion in those forums. So I think that encourages transparency. In terms of communications outside of those forums, that's where you really have to question, why is that communication occurring outside of the forum? Is it furthering your fiduciary mission? Sorry, and perhaps I'm not following the question sufficiently, so go ahead.
No, it's okay. So typically it would become probably from an inquiry from somebody else, right? I spend a lot of time in public policy circles, just people debating and talking about things all the time, right? So there's, you're always trying to provide some additional context in the spirit of that debate. I just wasn't sure that in the spirit, whether it's the public or something else, where a disclosure that would seem to be somewhat benign in the spirit of that conversation would run into conflict somehow with the fiduciary intent, as I'm trying to understand it better through your presentation.
Okay, now I understand your question better. So there's going to be a very big difference between having a dinner table private conversation with somebody about a topic versus speaking in a public forum. The First Amendment analysis in this balancing test looks very much at the time, place, and manner in which people are making these sorts of comments. And so this is not intended to be an instruction that you may never talk about LACERA privately or in a context where you're simply trying to inform people of matters in an appropriate way. What we're talking about more is where people are making public statements about LACERA business or identifying themselves as LACERA trustees without necessarily due consideration of the fiduciary responsibility that goes with that. And thinking about that in terms of the governance framework within which you all may wish to manage that process a little bit more closely.
So here's a really, if I take 60 more seconds of your time, so here's a slightly nuanced one, right? So in the public policy circles that I run in, diversity issues, expanded definitions of kind of shareholder capitalism are a big part of the topic. And by identifying myself, oh yeah, one of the things that I'm involved in is LACERA, right? And if we take into effect the public comment thing that we got earlier today from someone who's a current retiree, who just the very mention of ESG or social responsibility in their mind's eye feels like, hey, that's not something that we should even be talking about, right? Like we should just be talking about, straight up returns. So in that kind of protecting the system, right, in my role as a trustee and fiduciary, but having an expanded conversation around some of these topics that could be viewed as being in conflict with my role, that's kind of where I was just interested in just trying to better understand the boundaries of my role to be a protector of the system, right? Confidence in the system, but also being a willing and engaged participant in some of the enlarged conversations around it. You know what I'm saying? Like, just wasn't sure, or am I thinking too minutely about it?
So let me jump in here. I think that there's, if you look at, again, context is really important, but in the context that you described, I think it's one thing to have a good faith policy discussion about the issues that all public pension plan investors face, for example, and making statements or comments which really raise the risk of reputational injury, right? It's a great phrase. I love the phrase, protector of the system, right? You're always a trustee, and you're always in that position when you're acting in that capacity. And so I think, again, to a certain extent, this is judgment. And is the discussion that we're having, or that I'm having, is that really going to have a negative consequence for the ability of the system to be, its governance interests, as well as, my fiduciary responsibilities as a manager and protector, or not? And I think that, again, in that context, having a good faith policy discussion is much different than, as the existing policy puts it, casting aspersions on the organization or on the staff or on perhaps a decision, a specific decision that was made. And I think those are two very different things when viewed through the fiduciary lens.
The example, Trustee Jones, that you gave, though, I think is a good one, particularly in the context of the more recent policies that the Board of Investments and Board of Retirement have adopted relating to diversity, equity, and inclusion topics. Because to the extent that you're talking about a LACERA policy that's already been adopted, that seems to me to be quite consistent with your fiduciary responsibilities if you're simply explaining it to somebody. To the extent that you're talking about a policy that another retirement system may have adopted, well, certainly you can state your opinion on these things, but it's a question of in what forum are you speaking about them, and with what, and are you doing it in a way that is careful to express that here's a policy that's been adopted, I have views on it, but what level of vetting before you sort of launch into here's what LACERA thinks as simply one trustee, how far should you go in that is really the question.
Okay. No, thank you very much.
Thank you. I have Mr. Kelly, followed by Mr. Kehoe, followed by Mr. Bernstein.
Thank you very much. I really appreciated your memo, and so I think it's one of the few times where I read the memo and gave it more weight than I did a deck, because usually the deck is always kind of easier for me than a memo. But I thought you were really direct and clear in your memo, and I appreciated that very much, because I do think clarity is important here. And I thought about it in relation to one of the policies you mentioned, the Ethical Code of Conduct, which says that LACERA board members may use their LACERA position to identify themselves, provided that no statement may be made or action taken directly or indirectly, indicating that the person represents LACERA in any way. And your memo really paints a different picture, which is that when we identify as a LACERA trustee, we're always a LACERA trustee. And the reality of the circumstances surrounding that are the reality that we have seen play out in recent matters. And I think that's really important to consider. So I wanted to thank you really for your efforts and also for the training. And then I just wanted to just note to the chair, I mean, I think some of these policies do need to be reviewed in terms of this legal framework that fiduciary council is represented. And I just wondered what that road looks like. Is this a JOGC matter going forward to put on the JOGC agenda?
That's something we can certainly talk about. You know, I think we wanted to start first with this training. I know I was particularly interested in this, but why don't we circle back through the last couple of speakers? Did you have anything else, Mr. Kelly?
That was it. Thank you again. I appreciate it very much.
Appreciate it. And then we can chat as a group just afterwards, once we're done with the individual questions or comments. Mr. Kehoe.
Yes, thank you. This is in response to the question that Mr. Santos posed and the responses by Nasemin on this. I'm a little concerned regarding the response by Nasemin that the official policy is that we are to seek approval from the organization on candidate statements as an elected trustee. That has pretty serious ramifications, not just at LACERA, but across the entire state of California. I, as an elected individual, release a candidate statement every time, do candidate speeches. A number of us here that serve as elected individuals do the same thing. And to get this information vetted by ultimately the people who we're bosses to, going to the CEO and going to legal counsel, is just seems to be a bit much for me. Also, I have personal beliefs on the future of the organization and things that I'm going to do or vote for or support, and I have a right to say that and bring that up as part of a candidate statement, and to tie the hands of elected individuals on this board while having open floodgates on those who are running against us. It just seems rather silly. So I think we might have shot from the hip here on this and made a quick comment, and I understand that you get these questions here in the boardroom and you have to make a quick response. But I really think that this should be thought about, and the impact should be thought about before Nasemin has an official response on that. In addition to that, my stance is going to be that I'm going to continue the status quo with how I do my stuff, unless we have a board policy that says otherwise, which would be discussed and vetted by the organization. At this point, I don't believe we have any board policy that limits us in our ability to do candidate statements. So that's going to be my stance on that. In regards to the discussion, I mean, clearly it's a JOGC issue since it is a policy that would impact both boards. But if we wanted to have two separate policies, one for the Board of Investments, one for the Board of Retirement, then it'd be separate board issues. So my suggestion would be that it'd be a JOGC discussion, and then ultimately the individual boards would adopt it as a general policy for the organization. But I'll leave that up for further discussion with this board.
Thank you for that comment, Trustee Kehoe. And just to clarify, I was not stating a Nasemin opinion about best policy. It's simply food for thought in terms of how you wish to handle candidate statements.
Mr. Bernstein, followed by Mr. Green.
Thank you, Chair Knox. So one thing I've learned today is that we can't ever take our hats off. So Since apparently I am always wearing the hat of Chair of the Board of Retirement, I agree with Mr. Keogh that this should go to JOG C. I do think the policies need to be looked at, but I have concerns. I appreciated Mr. Santos's hypothetical, but Mr. Santos's hypothetical to me didn't raise an even more plausible and pertinent question, which is, what if you are running for a LACERA election under the argument that LACERA is not doing its job well, and you're the person who can help do it better? There's an inherent conflict that I'm hearing in these comments about critiquing the organization once you're a trustee. And yet, sitting here as an independent trustee, to some degree, my understanding from my experience here, from NACD, et cetera, is that my job is literally to critique. I just want to throw down my concerns about anything that tempers our legitimate authority and ability to critique strongly LACERA when we believe that she is not moving in the right direction. That is a concern for me. I also would note that we're having an ongoing discussion about whether trustees are employees, and I've actually to some degree pushed that conversation, but even I am somewhat thrown here at the degree to which Mother LACERA is trying to regulate us as trustees. I would note that when I was appointed to the Board of Retirement, to the Board of Investments, LACERA reviewed my application and weighed in on whether they thought I belonged. They thought I did belong, but they weighed in on it. There seems to be some indication that LACERA will be weighing in on whether, as candidates, we're saying the right thing. This is a very controlling stance, is my concern for trustees who actually should be running the organization. And I'm wary of it. I would note that over the 11 years that I've been here, I've occasionally heard that my comments have set people off the wrong way. I've generally worked to work on the relationships, but to validate my comments if I believe in them. And I would note that at times my colleagues have said things that I would have preferred they didn't say, but I'm here, as I believe most of us are, to defend people's rights to say those things. I'm not questioning the research or the presentation, but I'm troubled at any effort to control the liberty and independence of any trustee. And I hear a creep here in that direction, and it concerns me. Thank you.
Thank you, Mr. Bernstein. Mr. Green?
Thank you, Mr. Chair. Want to support Mr. Kehoe, Mr. Bernstein's comments. Welcome, Mr. Jones. I'm sure you're wondering what this is all about, so let me help explain it. We're really good about beating on the bush at LACERA sometimes, so this is what happened. So a couple of the trustees made comments to these outside news organizations and to various interest groups. So some of the folks, staff and board members, had a bit of a meltdown and say, okay, how are we going to regulate this? How do we rein in trustees speaking out on their views and, quite honestly, representing the way they feel about things? So this is what we do. We bring in our fiduciary counsel. We have you see my air quotes, a training on First Amendment rights. We have a group of bullet points that very subtly suggest that we need the permission of our chairs to speak to the media. We very subtly give examples of trustees at other funds being censored for speaking out on these issues. So, you know, the passive aggressiveness is overwhelming. I agree with Mr. Keogh. I agree with Mr. Bernstein. I think we need, as trustees, the right to say what we need to say. I think the folks that elected me depend on me to say those things. You're kind of damned if you do, you're damned if you don't sometimes with these things. But this is not a helpful presentation. This is not a helpful training. This is a scolding. So let's just call it what it is. Let's stop beating around the bush. I'm more than happy to take another hour in this training, but let's just call it what it is. We all know where this came from. We all know where it's going. You know, it's going to go to the JOG C. I'm not on the JOG C. I don't get a vote on the JOG C. So I'm glad we're having the conversation here, at least where I do get a vote, or I do get to speak my voice on the situation. But let's not play games and beat around the bush. Let's just call this what it is and explain what the root of it is, so we can all move forward and continue the business of LACERA. Thanks.
So there is some matter of transparency then, what I was trying to get at, right? The ability to speak freely about,
100%.
Yeah, so that's always a challenge in small d democratic groups. I just wasn't sure if I was understanding exactly the definition of fiduciary and whether that was a commonly understood restriction or versus, I'm appointed, I'm not elected, but I feel a small d obligation to speak honestly about the dynamism of debates, whether it's critical, whether it's supportive, whether it's expansive, because I'm a small d Democrat, right? So that's what I was trying to get at, but I wasn't. But I appreciate the background, David. Thank you.
So if I may respond a bit to a couple of comments. One, when we're talking about governance, we're talking about the boards governing themselves. So this is not an attempt to have your staff govern you. There are references in the training and in the materials to a potential role of certain designated people you've already elected to leadership roles, chairs of boards, chairs of committees, people whom you've hired to run the organization or parts of the organization, your CEO and your CIO, and people who have a legal responsibility to the organization, your chief counsel. So that is the intent. It's not to handcuff you. It's simply to identify those whom you've already entrusted with important responsibilities relating to governance. Secondly, there is a difference between the role of a trustee who's a fiduciary versus the role of a person who's not a trustee. And that was another important part of this discussion. It's not intended to be a scolding, just like any ethics training we provide or fiduciary training we provide. It's intended to set the framework for the discussion within the legal responsibilities that apply to all of you. And then it's up to you to determine how you wish to conduct yourselves as a group. But it's intended to provide that forum and the legal responsibilities within which you operate so that you can have a meaningful discussion. Yes, in response to some things that happen within the organization, certainly, but it certainly is not intended to be a scolding.
So Ashley, if I may, when I first started in 2011, you taught me most of this stuff, and you've been a great source of information, and I thank you for that over the years. I do need to point out that staff promulgated a policy that we discussed at the Board of Retirement a few weeks ago that gives them the authority to review all trustee emails when they choose to at their own election. In the context of what's going on, it is a bit disingenuous to suggest that staff isn't trying to some degree to control trustees. I personally believe they are doing it for the admirable qualities of promoting comedy and productivity, but nonetheless, that is the context in which this conversation is taking place. So without being absolutely clear, as I've tried to be, as Mr. Green has tried to be, as Mr. Keogh, other people have tried to be, I think we need to be really clear that we are not going to be here to be regulated. We are going to be here to do our job.
Let me just add to if I may, just very briefly, board governance policies are just that. They are board policies, and it is entirely up to the board members collectively to decide what they want in those policies and how they wish to govern themselves in fulfilling their fiduciary responsibilities. And so we tried to make that clear in this presentation, but if it wasn't clear, let me be as clear as possible, that this is all within the control, the collective control of both boards. And the discussion here is really to bring these issues up, yes, in the context of recent events, but not to force feed anything. And that it is, again, a collective decision on these issues.
I have Mr. Santos in the queue.
Yes, thank you, Mr. Chair. I agree with Mr. Kehoe, the previous comments. I didn't find this presentation to be well balanced. Pretty much his presentation is telling me what I cannot do, and I have to get permission from the CEO. I agree with Mr. Kehoe. We hired the CEO. So now all of a sudden I'm gonna have to report to the CEO. I'm gonna have to, every time I put out a campaign flyer, I'm going to have to get permission from the CEO. So this, quite frankly, was not helpful. So I agree with my colleagues' comments. Thank you.
I have Mr. Kryman in the queue, but I don't have any other trustees, and I wanted to.
I actually wanted to make a comment. It's Gina.
Oh, okay, Ms. Sanchez, go ahead.
I apologize for the background noise.
That's right.
I think one of the sort of thoughts that I had listening, of course, we all listen from our own perspective, and I recognize that everybody was speaking from theirs, and I would just throw in that, one perspective that was not really, I think, fully considered in the presentation was the perspective of somebody who is a subject matter expert, and I think Mr. Jones kind of started to talk about that in some way, but I'm going to just say it a little more differently, which is that if you come to the board as a subject matter expert, appointed, elected, or otherwise, and your business is to form opinions and make commentary out into the public, and I have done so for many years before I came to LACERA. My contract at CNBC far predates LACERA, and my credibility as a subject matter expert does not extend from LACERA. It extends from my actual career and accomplishments. And to some degree, I will not go to LACERA to ask for permission to form an opinion which is based on 25 years of my own academic work. So I just think that the presentation didn't really take into account a broad application of what it actually meant to say that we can never take off our hats. I think that's not even an appropriate comment, given the fact that, I had to sit and have significant legal, guidance and counsel when I first even considered this obligation for that exact reason, because my media footprint is larger than LACERA's. So, thank you.
Thank you, Ms. Sanchez. And I think I'll take the opportunity to weigh in before I turn it over to Mr. Kryman. And I certainly appreciate the perspective of my peers. I thought the presentation was very useful, actually. I think there's a tendency sometimes, from what I've observed in my brief tenure, to say, well, no, we've been over that, as Mr. Bernstein alluded to. Yeah, you were very helpful in 2011. Which was great, but there's several of us that were not here in 2011, 2015, 2018. So I think it's good to see some of these things. Yeah, there might be timing related, and I appreciate Mr. Green's perspective. I've told him before, I appreciate the role that he plays and his passion, and in no way, shape, or form was this meant to pick up on that. It was more so just sometimes I encounter things and it's like, okay, I wasn't aware of the complexities, and as we can see, we have a media policy that really covers some pieces of this, but there's a lot of nuance to it. Not everything fits under that media umbrella. I don't necessarily have the same appreciation for the election-based issues like Mr. Greenwood, Mr. Santos, Mr. Kehoe. So I think it's helpful for me to hear those. And it's only when we have these discussions that I can better appreciate those things, including Ms. Sanchez, because of the number of things that she is involved with. So I think there's sometimes a tendency to say, wow, this presentation didn't hit it on the head for me because of my particular feelings, which are, aligned with my responsibilities. And that's great. I appreciate that too. But I think there is value that we can all glean from this. And I know Mr. Kehoe heads up JOGC. So if he's interested in agendizing a further discussion, that's certainly up to him. And I would certainly welcome that. But it's not a mandate to force this one way or the other. So that was my perspective. I know Mr. Kryman is in the queue. Go ahead, Mr. Kryman.
Yes, thank you, Chair Knox. I have a couple of comments and observations, and I wanted to just make some comments about some of the comments that I've heard. So first of all, I want to say that that I don't believe that staff is trying to control the board. That's not what my intention is as the CEO. I think that it's important that we all understand that we all have different hats that we wear. We're not only LACERA members, but we wear other hats as well. So we have to, as the CEO, we have to take those things into consideration. I'm not interested in monitoring or getting involved in the election process of the LACERA members. I think that being in a position where I have to approve or censor somebody's candidate statement is not somewhere, it's not a place where I think it would be appropriate for the CEO or any official or administrator of LACERA to be. Is not appropriate. I think that most candidate statements are limited to the number of words that are included in the statement, but the content is yours. I think that the minority opinion, quite frankly, is usually is incredibly valid. And being critical of LACERA and their policies and procedures and their stances, I think, is important discussion, deliberations. So I think that making sure that there is a way for the minority opinion to come out during discussions, as well as, defending your record during an election or in discussions with others is valid. In the waters that I used to swim in, we used to hear a lot of minority opinions come out when one board of supervisors, for example, was on the losing end of a boat. And so I think that the line that we have to walk is, I as a CEO and John as the CIO and Steve Rice and Johanna have an obligation to make sure that we are addressing any reputational risks that may happen and address that through our PR folks, or if we have to have discussions with you all, we should have discussions with you, and I think you would welcome those sort of discussions about the implications it might have on the reputation of LACERA. So I'm not sure what it is that you're asking us to go back to with the JOG-C. If you're looking for us to look at the media policy and revamp that, taking a look at the ethics policy, which I know that Mr. Rice had drafted a few years before I got here. I think he's in the process of reviewing it as well. So some guidance from you all about what it is that you're asking us to do would be very, very helpful at this particular point in time in terms of what we're going to do with the JOG-C and how we're going to address these particular issues. I have a different take. I think that that all of your opinions should be heard. Am I happy that about some of the things that you all say? No, it makes my job a little harder, but that's my job. My job is to deal with those particular issues as they come. So with that, I'll turn it over to Chair Knox.
Thank you, Mr. Kryman. I did not hear a specific directive this morning in this regard. Again, Mr. Kehoe's the chair of the JOGC. I see he's also next in the queue. So, Mr. Kehoe.
Yeah, I was just going to say that what we'll do, I think, to help expedite this conversation is we'll have this brought to the JOG-C and we can discuss if there's any action that needs to take place based on this review and presentation. There might be some minor tightening up that needs to happen. We'll discuss that if necessary. And then ultimately everything would be presented to both boards for discussion and deliberation and adoption. So that's probably the right way to go in light of this conversation.
Thank you very much, Mr. Kehoe. I don't have anyone else in the queue. Thank you.
Oh, I was just going to remind everyone that we also are going to have the same presentation to the Board of Retirement on May 5th. So maybe we'll revisit this subject then on the 5th.
I welcome Mr. Bernstein wrangling that agenda item at the BOR in the future.
We look forward to it.
Anything else? I'm sorry, Mr. Kehoe, were you going to say something?
No, you summed it up well.
Okay, perfectly. Thank you. Thank you again for the presentation. Just in terms of a time check, I know we've been going a little bit again for a while. We do have information only items that have no holds. So we can do items for staff review, good of the order, and take a break before executive session. Unless I hear otherwise, that's what we'll do.
Mr. Knox, I know Mr. Kelly had a couple of items he wanted to
Correct.
pull.
Those have been released in the
Oh,
interest of good discussion and debate and time.
okay, sounds good.
So let's do that. So we have E through L information only, unless there are any questions or holds on those.
Mr. Knox, I did just want to thank staff from multiple divisions in all of their efforts on the cost of living issue. It really was a tremendous effort they undertook, and I know all retirees benefit, and I just wanted to acknowledge their efforts and thank them for it.
Thank you, Mr. Kelly. Item 10, items for staff review. Linda?
Yes, I have 3 items. The first item is the board requested that the OOC CISO presentation provided on April 7th also be provided to the Board of Investments. And the board requested information regarding member communication for LACERA for those who do not have an email address on file. The board requested for staff to bring back a memo regarding the OPEB master trust as to county's ability to withdraw and input into the investment types. And the last item was for Mr. Kehoe. The board requested the First Amendment presentation be brought to the JOGC.
Thank you very much.
You're welcome.
We are on to good of the order. Can you please call on everyone, Linda?
Absolutely. We will start with Mr. Green.
I don't have anything. Thank you, Linda.
Thank you. Mr. Santos? Okay, I'll come back to Mr. Santos. Mr. Kehoe?
Welcome, Patrick. Yeah, this is about a pretty standard board meeting here, so get ready for it.
Miss Green was not here. Mr. Jones?
Yeah, thanks for everyone for being so welcoming, including those who had reached out prior to today just to make themselves available for questions and things of that nature. So I'm looking forward to being a contributor and of service to the county and the members. Thanks.
Thank you. Mr. Bernstein? Okay, we'll come back to Mr. Bernstein. Mr. Kelly?
I am, I guess, one of the 25% of California residents who are fully vaccinated. So don't forget to go to itsmyturn.ca.gov and sign up and make sure you get vaccinated. Thank you very much.
Thank you. Next, Miss Sanchez?
So I am in that 25% with Mr. Kelly and very much support that comment.
Okay. Thank you. Next, I'll go back to Mr. Santos.
Yes, thank you. I apologize for not being available earlier. Yes, I'd again like to thank Mr. Jones for your service and as a member of the fund, an employee with the county. I appreciate your service. It is important that we hear from people like yourselves and all the appointees, because being able to speak your mind is important, so that way we can make the right decisions. So again, I really appreciate and thank you for your service, and looking forward to hearing all your ideas, irrespective of whether I agree with them or not, but I welcome your input, just like I welcome the input of all my colleagues on both boards. Thank you.
Thank you, Mr. Santos.
Okay, next, Mr. Bernstein.
Sure. I got kicked off for being too controversial, I guess.
That was me.
Well, Chair Knox, there it is. Mr. Jones, welcome. Mr. Drasel, again, congratulations on your election. Ms. Fontenot, thank you so much for stepping up so quickly at a challenging time. And just a very personal opinion, I don't think that the measure of a board like this is how well we get along. I think it's how politely we disagree. And I think that we had some tough conversations today and we handled them well. And it is, of course, nice when everyone agrees with me because it makes me think you're smarter. But often down the road, I learn a lot more when you disagree. So I really appreciate the robustness of our conversation today.
Thank you. I'll call on Santos Freeman.
Nothing for me.
Okay, John Grable.
Thank you, Linda. The term expertise was just used, and under that theme, I'd like to introduce 3 people to the board. We have 3 additions to the investment office. The first is Magdalia Cerna Armstrong. Magdalia joins us from Dimensional Fund Advisors. She is a senior investment analyst in our global equity group. And under the term or theme of expertise is a master's degree in financial mathematics. So welcome, Magdalia. The next addition to our team is also a senior investment analyst, Crystal Milo. Crystal joins us from Glass Lewis. She is part of our growing corporate governance initiatives. And under the theme of expertise, Crystal's has a master's in public policy. So lots of different viewpoints and thoughts will come from both Magdalia and Crystal. And then the third person I'd like to introduce is an investment officer in our real assets team, Pushpam Jain. Pushpam joins us from Infra Investor, UBS Asset Management, Franklin Templeton. He has a PhD in public policy as well as an MBA. So I guess we get a double level of expertise there, but I would just like to welcome all 3 to the investment team. I'm really excited to be your colleague.
Yep.
Okay, next we'll call on JJ.
Just want to welcome Mr. Jones to the team, to the trustees, and look forward to getting to know you and working with you. And welcome all the new staff members in investments that I haven't had a chance to meet yet because we haven't been in the office yet. But looking forward to working with them as colleagues as well. Thank you.
Okay, Johanna.
Nothing, thank you.
Okay, and last but not least, Chair Knox.
Mr. Bernstein, you had something else you wanted to add quickly?
I just wanted to mention that Chris Wagner and really the entire team spent a huge amount of time with me at one of these informal coffees. We talked about private equity. I just wanted to thank staff for setting that up. I wanted to thank everyone who participated, and I wanted to encourage my colleagues to take advantage of that opportunity because it was really terrific.
Thank you, Mr. Bernstein. And for myself, just a few quick things. Thank you and welcome to Magdalia, Crystal, and Pushpam. Welcome the investment team. Welcome Mr. Jones again. Our unsung hero this month was just the entire real estate team, just for working through the succession in a very positive and constructive way. We certainly appreciate your efforts. And then John mentioned the Roaring 20s may not be good for everyone, and it was just kind of interesting. I got a pop-up the other day from the New York Times saying that ArcLight was not going to be reopening, and it's just interesting to think that you've made it this far. The movie theaters you hear about are just about to reopen, and I think we're going to see more instances of that. This thought that, well, no, you've made it this far, everything's just opening up. Mr. Kelly's talking about the vaccines, but yeah, that we may not see a lot of these companies coming back. So that's just kind of tough. And then the last thing I wanted to add, I think we'll carry over from the BOR where we adjourned today in the memory of Remy Feliciano, who was a LACERA employee that had passed away. So without any objection, I would certainly like to close out the day with that. So with that, thank you. Why don't we take a solid 15 minutes in honor of how hard we've been going here, and we'll come back at 12:48.